All right. Call the May 28, 2025 Investment Advisory Committee meeting to order. Welcome, everybody. Thank you for being here. Important evolution of the portfolio. We're going to talk a lot about that today. So thank you guys for being here in person. I know you all have traveled from far, except for you, Dan, who's close. But everyone, I really appreciate the time because I know you guys are all busy and have other gainful ways to spend your day, but we appreciate you being here with us today. So let's begin with the Pledge of Allegiance and the salute to the North Carolina flag. I pledge allegiance to the flag of the United States of America and to the republic for which stands one nation under God, indivisible, with liberty and justice for all. I salute the flag of North Carolina and pledge to the old North State love, loyalty, and faith. Over to Jason to call the roll.
Good morning, everyone. My name is Jason Sass, and I serve as Deputy General Counsel at the North Carolina Department of State Treasurer. So first, I'll take roll call of the committee members to confirm we have quorum. Then I'll go over a couple of reminders for our public meeting. So for the roll call, Mr. Lance Brewer.
Here.
Mr. Robert Durden.
Present.
Mr. Michael Kennedy.
Here.
Mr. Jamie Spencer.
Here.
Mr. Dan Ward.
Here.
Treasurer Briner.
Here.
And we have quorum. So thank you, committee members. Here are some quick reminders for our public meetings. For those who have called in, please remember to, and this is for people who are observing as well, please remember to mute your phone when you're not speaking. Please state your name when making or seconding a motion. If you need to leave the meeting, please speak up to let us know. And if you rejoin, please identify yourself. Probably not as relevant with everyone here today. For anything that this committee votes on, the votes will all be by roll call. We will deem the members who make the motion and second it as voting yes. Finally, a reminder to anyone speaking from the audience during the meeting, please remember to stand and clearly state your name, title, and organization for the record before proceeding to speak or answer a question. Today's meeting agenda is posted for public availability on the Department of State Treasurer's website at the Investment Management Division page. If we lose the phone line connection altogether, not really relevant here because they're never phone here, but if we did, the meeting would be deemed to be in recess, or if people have to leave and we lose quorum, it'd be in recess. And then we'll put on notice the homepage when we have information about time to resume the meeting. Are there any questions about these procedures? Great. At this time, I'll turn the meeting over to the chair for approval of last meeting's minutes.
Okay, in your packet, you'll have the minutes from the February 26, 2025 Advisory Committee meeting. Is there any discussion, questions on those? I'll entertain a motion to approve. Second. Durden and Kennedy. Call the roll, please.
Okay. Mr. Brewer.
Aye.
Mr. Spencer.
Aye.
Mr. Ward. Aye. And Treasurer Briner.
Aye.
And we have approval.
All right, thank you very much. So we'll turn it over to Kevin, our Chief Investment Officer, to go through major initiatives.
Great. Good morning. So on the agenda today, I'll do an update on our major initiatives. Then we'll walk through with the private market asset classes, the pacing plans. And then finally, we'll do a brief performance update through the first quarter of this year. In terms of the major initiatives, the updates are on rebalancing, governance update, and then just a couple of words on where we're at in terms of human capital, mostly hiring folks, but we kind of got a flavor already in terms of the new adds to the team. So our rebalancing process, I covered this in February. We're basically approaching it in 3 stages. The first phase was through March, and it was to prioritize deploying a portion of our excess cash. So we came into the year with about 6 to 7% excess cash over our policy allocation. We had some structural misfits in the plan that we wanted to address because they weren't really informed by a view on the markets. This meeting, we're going to talk, like I just said, about the pacing plan. So you'll get to hear from the asset classes around their views of opportunities and risks in the various subsectors. And then we'll come back in November with the results of the asset liability study. So the phase one that we reviewed with y'all back in February the plan was to redeploy about 40% of the excess cash, retain a fair amount of dry powder so we could take advantage of opportunities as they evolved over the next year, as well as recognize that as we kind of restarted the commitment pacing on the private side, that we would need to have readily available cash for those purposes. Our focus was on, we had large underweight, 350 basis points in the growth area, and both in the public and the private. And so we wanted to address that. On the investment grade fixed income side, we felt the opportunity cost of holding the excess cash relative to where yields were at in our longer duration fixed income was tilted more towards the duration, even though we saw the risk of rising yields. But we felt the payoff was kind of asymmetric in our favor, given the level of starting yields that we were at. And then we've looked favorably on low duration asset-backed securities, so CMBS and some structured credit as well. And we've been focused on redeploying there also. So here's the update in terms of the numbers. What was approved in February, a combination of prior to the IAC meeting and subsequent to our discussion, is shown in the kind of the left-hand panel there, phase one. So 3.3 billion of movements out of pension cash were approved. And you can see we sent some to investment grade fixed income. So that was adding to our duration exposure. On the domestic equity side, we added about 3 billion. And on the international equity side, we are overweight there. So we rotated into U.S. equities. We also had approved about 550 million in opportunistic fixed income. So that's our sub-investment grade exposure. And then the inflation sensitive, and that's where we were looking at shorter duration, asset-backed securities, various flavors. So what's been completed to date is in the next column. We've drawn down cash by about 2.8 billion. You can see the homes that we found there. We're basically on track for what was approved, with the exception we're a little bit behind on opportunistic fixed income. Some of that has to do with we closed with a manager, but they're drawing money as they find the opportunities, right? So that will flow out over time. And then we had some organizational change or potential organizational change with one of the targets of a manager, a strategy we wanted to fund. And so we've deferred that for now until we see the dust settle around some of the organizational changes. We also did a interim rebalancing right after Liberation Day, when the equity markets fell pretty hard. And so we stepped into that with 1.3 billion, put that in U.S. equities. The target there was very similar to what we did in the February rebalancing, which was to target a internal active quant product or strategy that tilts away from some of the higher momentum names, the Magnificent Seven names, and is more geared towards value exposures, a little bit more small cap. So it's somewhat defensive, at least relative to what we've seen over the last, say, 18 months in terms of what was the most popular in the U.S. market. And I guess in a nutshell, the transition, both of them went quite smoothly from an operational standpoint. There's always certain delays in international markets in particular, because you have to take into account the trading days and the vagaries of when the markets are open and not open. We had that, like I said, a little bit of less rebalancing into opportunistic fixed income than we would have liked. But we've been tracking the P&L, and we're not trying to maximize the P&L, because a lot of this is intended to kind of focus on the medium term, the long term, having the right balance and risk management within the portfolio. But depending on the day, the P&L relative to remaining in cash has been running about 70 million to about 170 million to good. So we happen to get, I think, the timing right. A lot of that's luck. So we're not trying to take credit for kind of seeing the future. But the interim rebalancing that we did in early April has definitely been impactful given how much markets have bounced back since then. So far that's working out well for us for the plan.
Kevin, just a quick comment. Kudos to you all and the team. The day on the 11th was very dull. A lot of days in April that were volatile. It was a very dull time.
Yeah. So to be clear, we had a bit of a debate because the markets were moving around a lot and in terms of the timing. But again, it's to be, clear around our philosophy around this, and it's going to come up a bit later as well. Our rebalancing discipline is by policy. If we're outside the rebalancing tolerance, which is plus or minus 2% for public equities and investment grade fixed income, if we're outside for 5 consecutive days, then we either rebalance or we get a waiver. And over time, occasionally we get waivers. We ask for those because the markets might be so volatile that we just don't feel that, we have a lot of clarity as to where they're going to settle. But by and large, we like to do that rebalancing, and we've stuck to that, at least during my tenure here. That over long periods of time tends to work out reasonably well in my experience. It economizes on the transactions costs of rebalancing too frequently. And when we do rebalance, we don't rebalance back to the policy target. We just go 50 basis points, sometimes 100 basis points inside the rebalancing tolerance. So if you trigger at plus 2%, or if you're outside that for equities, like right here, you can see, well, you'll see a bit later, we're running right about 2% overweight our long-term strategic asset allocation target for public equities currently. We just go 50 basis points inside of that. And then sometimes the market pushes us out again. More often than not, we kind of just stay inside the rebalancing tolerance for a period of time. When markets trend, this tends to work well. Equities, if they're going up, you just keep rebalancing down and taking a little bit of profits off the table, and vice versa. It's a good discipline against some of the behavioral biases that creep into the investment management processes sometimes, that like, wow, the markets are really down heavily, and is this the right time to be buying stocks? And this forces the team, the organization to kind of say, well, we're supposed to, and if we're not going to rebalance, we have to have a reason. And that's when we would seek a waiver. So, okay. This is just a reminder that for the asset liability study, we'll be coming back in August with the committee and talk about a little bit of an educational session on how asset liability studies work for pension plans, the capital markets assumptions that we're considering, how we would expect to model. And we're in the kind of the middle innings of selection of a asset liability consultant. So we use an outside firm. The last study we used Callan. We're looking at 3 different firms currently, and they do the heavy modeling because both liabilities and assets have to be modeled jointly. And so we'll come back. That'll be a major part of the next meeting in August. And then again, the payoff ultimately is in November. We should have some recommendations. And then we'll go to the teasers and Elders board, and in January we'll may come back in February of next year with some fine tuning. So that's the basic plan. I'll switch gears to governance. So on the governance front, a couple of different things. We have this consultant study that happens every 4 years according to statute to look at our governance operations and investment practices. RBK is the consultant that's been chosen. They're going to bring that report in August. So there'll be an opportunity to get a independent third-party review as to areas we might need to strengthen and enhance. And so that'll be in front of the committee. The other thing I want to give an update on is the legislative initiative around the governance. So we've had really strong welcoming acceptance from the General Assembly on this initiative, which we're calling the 2025 Investment Modernization Act. And the overarching focus, again, is really to try to improve the long-term performance of the retirement systems. And the goal is to improve the returns with maybe a modest amount of additional risk, which is going to be the topic when we look at the asset liability study. And but it's to be able to improve over time the funded status, also improve the likelihood of being able to grant COLAs to the retirees, since that's a function of the returns. And where we're at with the legislation is it's passed the House of Representatives within the General Assembly. It went to the Senate. There were some relatively minor technical amendments passed the Senate. And the General Assembly is currently on break. When they come back, we expect it to come up in the House. And because it was originally passed by the House with minimal amendments, we are increasingly optimistic that it will pass the House and then go to the governor. And the governor has so far expressed support for this legislation as well. So we think we're in pretty good shape. The kind of the summary of the legislation is it'll create a 5-member board. The appointees will come from one from the Senate, one from the House, one from the governor, one from the treasurer. The governor and the treasurer's nominations will have to be confirmed by the General Assembly through a resolution. The minimum qualifications are 10 years of successful management of pension, foundation, endowment investments. So we're looking for, practitioners really that have demonstrated success in the same kind of business that, we're trying to accomplish here. And we have 6-year terms that'll be staggered with a maximum of 2 terms. So the idea is that even though the appointees come from politically elected entities, the membership is independent in terms of their terms from the election cycle. So that creates a good continuity. By the same token, you don't get appointments for life. So you get 2 terms, so that's 12 years. And then there's the ability for the first term would be less than 6 years to create that staggering. And so it should be good continuity, good degree of high professional qualifications. And so this is really in line with best practices. If there's a vacancy, and the vacancy exists for 6 months or longer, then the treasurer can nominate and the board can approve a new member. So we also like that. That's very similar to what you see with a lot of corporate boards where there's self-replenishment. And I think in the commission that Michael chaired back in 2014 that looked at governance, that was one of their recommendations as well. So the notion that there should be this self-replenishment. In terms of the board duties and powers, is very focused on strategy, policy, and large key transactions. So they would approve the risk appetite, which would be expressed in stock and bond equivalents. So the idea of how much would be allocated to growth-oriented investments versus the kind of risk stabilizing high-quality bonds. And then each of the asset classes would get mapped into that stock and bond equivalents. Policies, key contracts, such as the custodian contract, external auditors, those would be the type of contracts that would come up to the board. And then large investment transactions, which we haven't tried to define in statute. That's what the board would define in their delegation of authority to the team, the staff versus the board. But it could be defined by asset class, could be defined by active versus passive, private market commitments, and any number of variations according to the desires of the board. Budget would be approved at the board level and headcount staff. The CIO would report to the board as opposed to the treasurer. And we would have the board making those determinations around hiring and firing the CIO. The term of the CIO is limited to 5-year increments. So again, you don't get appointments for life, and it has to be kind of regularly reviewed in terms of the appointment. The final thing that the board would do that's of some note is the actual assumed return, which is a key assumption for valuing the liabilities of the pension plan. And it will have an impact on the ability to grant COLAs. The interplay between the assumed return and the actual returns kind of drive the ability to grant COLAs. What we're calling North Carolina Investment Authority Board will make a recommendation to the teasers and Elders board. Most likely, we're anticipating won't be a single number. It'll be a range of reasonable numbers. And then the board of the retirement systems, which are the teasers and Elders board, will make the final determination working with the actuary. So that's another kind of new responsibility. The other thing that we're quite excited about in terms of the substance of the investment program is we've long had a series of complicated legal limits on the amount that we can allocate to different asset classes. So by and large, we're going to maintain the same flexibility around the things we can invest in, but those caps go away with the exception of two. So there'd be a floor of a minimum of 20% in investment grade fixed income, but that doesn't speak to duration. So that target duration that we would be aiming for would come out of the asset liability study. We always examine different types of bond strategies. And then the board ultimately is going to make that decision as to where they think we should position in terms of the high quality bonds and duration. And then there'll be a maximum of 40% in illiquids. So in statute, we did not try to define illiquids because we could pick a model from the mutual fund world where there are some regulations that govern mutual funds in terms of how they think about illiquid assets and limits on that. But we're in a very different kind of environment, right? We have fairly good certainty in terms of the demands that we face for external liquidity to pay net benefits. So the benefits net of contributions that come in from employers and employees, as well as our capital commitments that we have for our private investments. And so the idea is the board will make a determination both on how we define illiquid investments, as well as they'll certify annually that we're within this 40%. So it's really viewed as a board decision. Expectation is that we're going to have some form of a strategic asset allocation, similar to what we've had in the past, but the limits will be set by the board around how we define the asset classes and then the flexibility given to manage the plan on a day-to-day basis. We're going to talk more in August about the notion of having more of a total portfolio approach, where we can have some systematic commitment pacing in some of the privates like private equity, but retain some flexibility so there's a good strong competition for capital between private equity, real estate, opportunistic fixed income. The art is going to be deciding like what's the flexibility and how much of ongoing competition for capital there is on a kind of day-to-day basis versus trying to maintain a long-term strategic asset allocation. So that's going to be a great opportunity, I think, to get input from the board as we work our way through that kind of retooling of the investment program. And then the amount of risk that we're expecting in the program going forward, as we've talked about before, we expect to add risk. We felt we've been under risked for quite a while, but we don't see this as a quantum leap in the amount of risk or types of risk that the plan takes. And in statute, this new legislation, it speaks to the fact that the board will avoid undue risk relative to the average U.S. public pension fund. And we don't feel that's constraining, but we think that's a good hallmark for the stakeholders, the constituents of the plan to understand where we're going to situate the risk. And of course, risk is very multidimensional. So again, that's where having a good, strong professional board, I think, is going to be quite helpful, actually. Any questions on this?
Yeah, so Kevin, let me weigh in. And first of all, I just want to congratulate you and the treasurer in leading the effort to get this done. Because back in 2014, we did the comprehensive study, and I think a lot of the findings here are in line with what we discussed going back over 10 years. So it's exciting to see that this has finally been implemented here in North Carolina. So I just got a couple of thoughts. In looking at the creation for the investment authority and the board, the 3 bullet points, and based on the study in 2014, as well as the opportunity that I have at Korn Ferry to work with most of the large public pension plans in the country, I think this is a very thoughtful approach that you are following. So the 5-member board is probably a bit smaller than many other states, but I view that as a positive. Because there are some states where you have 20 people on a board, which is unwieldy. So I think that's a huge plus. I'm glad to see that you have the minimum professional qualifications. That's going to be key so that as the various stakeholders make the appointments, there are some guardrails around that. And then finally, the 6-year terms, I think is great because many public boards, the terms are usually maybe 3 or 4 years, and I think it's better to have the longer tenure, 6-year terms, because that means you can have someone who can be there for 12 years and maybe work through a cycle and things of that nature. And also, in looking at the fact that many of the stakeholders are elected are 4-year terms, then it provides a little bit more continuity than you typically would find. So I think it's a well thought out plan, and kudos to you. I realize it's a little bit early because it hasn't been finalized yet, but I think this legislation would move North Carolina to close to the top amongst a lot of other public pension plans just based on the governance structure.
Thank you.
It's a good thing that there's no penalties for plagiarism in this because in 2014, we've looked at a lot of other states. And so kudos to Kevin and to Andy, who was really helpful in surveying a lot of other states and learning from their mistakes and their successes. So thank you.
Yeah, and we need to give credit to Jason and Ben, our general counsel as well, who did a lot of the heavy lifting around, particularly around North Carolina statutes. And we looked at a lot of other agencies and departments as well to try to get it right because there's quite a diversity of approaches. Some work better than others. And so I think personally, I'm a huge believer in getting the structure right. Execution can always go wrong or awry. So you can't lose sight of that. But I think if you set the right institutional structure, it really makes it much, much easier. Yeah.
Touch on timeline of implementation.
Yeah. So in the legislation, there's 2 key dates. The first is July 1st, which would be when the board could be assembled. So upon the board being assembled, then the CIO can be appointed. Then the change in the statutory legal limits, that would happen July 1st, and that's when the powers and responsibilities would transition from state treasurer, that role in statute, to this new North Carolina Investment Authority. So the expectation is over the next 6 months or so, assuming the legislation passes, that we'll be in transition mode, planning mode, and starting to get the board appointed as well as start to build out the organization. And this new organization would still be located in the Department of State Treasurer, but generally be independent of the department. So that I like as well. In particular, I feel drifting too far away from, the key relationship of not only the chair, but the overall department, who still will receive all the monies that go into the retirement system, into the investments, and then transfer it over for deposit effectively with this new NCIA. I think having that relationship, as well as with the Retirement Services Department. I saw Sam come in here, the head of RSD, there he is, and his team and the actuaries. I mean, that, in my experience, that's really key to ensure. And sometimes I feel like I'm trying to play down the importance and the intellectual challenges and vigor of the investments. But, we never really want to lose sight of the fact we're here to pay benefits on time in full, right? And that's so essential. The investments can be really interesting and fun, but ultimately we have to always keep in mind that that's what we're here for. So, okay. I'm going to move on. Another couple of topics on the governance front. We've pushed forward with an update of our key policies. So last time we talked about an adjustment to the investment policy statement for the retirement system to go back to what was in place in 2022. And that will get taken up again as an output of the asset liability study. We've also updated our manager selection, manager monitoring, our investment committee charter. So we meet weekly as an investment committee and take up all the kind of the stance, our overweights and underweights. We talk about the market conditions, talk about our pipeline, and then we take up each of the investment recommendations for new investments, fund commitments, rebalancing, those types of things. The signatory authority policy is really the delegation from the treasurer to the CIO and to the directors of the asset classes in terms of what authorities we have to do things day to day. Then we're still pending two other policies. Our investment transaction disclosure, that's really dates back a number of years to how we interact with placement agents. So we do interact with placement agents because oftentimes they're the outsourced kind of business development and capital raising arms for the investment managers, especially the smaller ones that we deal with. And then the proxy voting policy, we're taking a hard look at that again in terms of how we implement our proxy voting. The other thing I wanted to raise is that we've had discussions throughout 2025 around how we view China and Hong Kong in terms of our exposures. So, we've been quite cognizant, as others are, of some of the long-term headwinds that those two domiciles face in terms of their economies, some social stresses, and the impact on the markets and the kind of the investment opportunities. And I think what reinvigorated kind of a revisiting how we manage the risks associated with those two sets of exposures was kind of the impact of the tit for tat approach on tariffs coming out of Liberation Day. And so even though there's been a bit of a pause in some of the war of words, if you will, we really think, as do a lot of others, that we could well see kind of bilateral tariffs settle in the 50 to 60% range, maybe lower. We can't predict, right? This is going to be a long, complicated negotiations, I suspect, on many fronts, not just tariffs, but other security issues and things like that. And so what we've settled in on, and we wanted to review with y'all, is you can see our exposures in the table down to the left. We've got about $2.4 billion as of mid-May in exposure. Most of it is public equities, and most of that is coming from our index exposure. We have a significant amount of the plan indexed in public equities, and we have some smaller exposures in the other asset classes. So our primary concern is the passive exposure, where we just simply have individual equities that are held through index funds. And we feel that that's where we would like to step away and not have that passive exposure. We're more comfortable with our active manager exposures. And we've looked at those in depth, done some analytics as well. And when we look at our active manager exposures, which are predominantly stock pickers, or in the case of our internal fixed income portfolio, individual bond, pickers, we see that if you look at their China exposure and compare it to how much is stock selection, stock specific, idiosyncratic risk, it's split about 25% to China exposure and 75% to really idiosyncratic risk, where they're just choosing individual stocks for particular reasons. They're not trying to get broad China exposure. So the approach we like, and we've seen this with some other pension funds, is that we would take China and Hong Kong out of our benchmarks. So for the index funds, they just transition to new products, excluding those two countries and securities issued in those two countries. And then for the active managers, if they have allocation to individual securities, it's just an active bet, good or bad, depending on their judgment. And they'll have the flexibility to continue to hold, to sell, to buy in the future. And we feel that that's a good way to balance where we think the key risk is, which is there's effectively systematic risk by having exposure to these countries because of the various issues. But the individual managers are able to go in and out of the market and these particular securities using the judgment that we've hired them for. And we still have conviction in all these managers by definition because we're holding them. So we like that approach. We have a single name co-investment in private equity that's been in process of exiting. We're looking at a secondary market price that's actually quite appealing. So that'll move forward. And then we have some commingled fund exposure in private equity and in real estate. We don't anticipate trying to exit those at all. Our sense of the secondary market price is it's not appealing. It's not in the interest of the plan to try to force that exit. And the intrinsic value of those limited partnership units is higher than what we could get in the secondary market. So we would stay the course. And then, of course, we would want to revisit this periodically. One of the key things that, we're sensitive to, and you can see it so far in 2025, despite all these long-term secular headwinds, sentiment around China and Hong Kong started to improve this year. There has been some stimulus. So both the fiscal and a monetary impulse has helped the markets. A little bit more clarity around some regulation, but not really, a quantum leap forward. And the markets have reacted very favorably because they've been beaten down so heavily. And on a valuation basis, China and Hong Kong look, like they're really, really compelling from a valuation in that single dimension. So we have seen this in the past, that those markets can rally remarkably high, like up 30% in 1 month, right? So we want to be sensitive to that as well. So we will need to continue to review this top-down approach on a regular basis and make sure we, continue to have the same view. So I'll pause there for questions and comments.
Kevin, the quick question is Taiwan included in your definition of China here?
It is not.
Taiwan Semiconductor, for instance, so that's not in the public agreement?
No, that's an area that we'll continue to look at. Clearly there's some geopolitical risk around China-Taiwan relationships, but that's not something we're comfortable yet with taking any kind of like top-down decision. Yeah. Obviously, we're interested if others have different views on that because it is an active discussion internally.
Kevin, I think this is the right strategic approach as it pertains to China and Hong Kong. And I know the current Secretary of State still looks at various pension plans and their exposure. So I think the shift to the new index is going to be something that will resonate within DC. So I'm glad that you're sort of getting out in front of that because many states are still struggling with what their approach is going to be and addressing China in particular.
Yeah. Now, we do have, our focus today is largely or almost entirely on the, North Carolina Retirement Systems, which is the DB plan. We also oversee and help support the supplemental retirement plans, which is a 401k plan for various public employees, as well as a 457 B plan, a deferred comp plan. And we'll engage with that board in one of their upcoming meetings to see what their appetite is to do something similar. But that first step is the North Carolina retirement system.
Kevin,
Go ahead.
so what approach are other pensions across the country taking?
So, yeah, so my sense is there's like kind of three categories of approaches. The first was politically motivated, which largely came from general assemblies or executive branch initiatives. And it was more focused on the security risks associated with China and the view that US and China are in competition on several different spheres and dimensions. And so that was more politically driven. There's others, Florida is taking a very similar approach to this. And then there's the third, which is do nothing and just kind of ride it out. And so I think, to be blunt, we were comfortable to a certain extent until we saw the tariffs really get applied, and then the kind of in the tit for tat announcement of tariffs. But I think with that change, certainly my own perspective is the whole risk dimension around these exposures is really shifted significantly. And so this is something that over the next month and a half, we would be expecting to implement. Yeah.
So what's the policy weight in dollars to China? What would it be? And we're talking A shares, Hong Kong, and then US ADRs. I can never remember US ADRs are even in the ACWI.
Yeah.
I think they are.
They are, yeah. And some of our managers have exposure to the ADRs as well. Yeah. And I think there might be some GDRs and things like that as well. Within equities, I think it's about 3%, Rhonda?
Yeah, 3.4%.
0.4%, yeah. And so I'm horrible at arithmetic. So 2.4 over 127 billion, roughly speaking, is kind of our overall percentage allocation, yeah, to China and Hong Kong. Yeah.
Of the total 2 billion in public equity, how much is active and how much is passive?
I think if memory serves me, we would be exiting about 950 million out of our index funds, and I think it leaves about 850 in our active, if I remember correctly. Might have the numbers reversed, but it's roughly in that ballpark. Yeah. Is that correct?
Yeah. And, our Greg Taylor back there that I pointed out, he's our structural analysis guru in public equity. Correct me if I'm wrong, 970 in active?
That's, I think, just under half this index.
Yeah.
Yeah, final question for me, just to understand. So those managers, active managers for whom it's under their discretion to buy US ADRs or not, will there be a communication change to them?
Yeah.
They will. Okay.
So we'll have to go through a formal process to amend the contracts to change their benchmark. And then we have to do some onboarding of the benchmarks and all that stuff. And then for the passive, there we would be moving monies into a new fund. Yeah, exactly. Yeah. And Rhonda and team have been having conversations with both the passive managers as well as the active managers since the beginning of the year, really, exploring the topic and how we might approach it. Okay. Thank you. So the last piece in the major initiatives is just an update on human capital, and then we'll move on to the pacing discussions. So we started the year or ended 2024 with 24 positions and 9 vacancies. Since then, the team, myself, our HR team as well at the department have been hard at work recruiting, and we've had 8 positions accepted. That still leaves us 7 positions that we're looking to to fill, and we've got good leads. We're advanced in a number of discussions with analysts as well as portfolio managers. And, if you roll it all forward, the math is a little challenging, but we have 30 staff, including the accepted individuals. And then we have 4 interns. We've had 1 come and go already, and we have three active interns right now. And kind of the experience set, you'll see some of it today when the teams come to the table. But we've added folks in real assets, real estate, private equity, public equities, and multi-strat. And the analysts are around 11 years plus of experience. And then the more senior folks that are at the PM or the director level are up to 35 years of experience. So we've been really pleased with the folks that have come on. We spent a lot of time, very involved process to have candidates meet the broader team. We want to have good cultural fit. And, we want people to bring independent views and different experiences. But, we try to be collaborative. We try to have good cohesion across the teams. We're not a eat what you kill kind of organization. So that's really, really, really key. Over the balance of this year and into next year, I'm going to put a big emphasis on hiring experience with folks that can do directs, whether it's real estate, real assets, credit, sub-investment grade credit. We have some need in operations, so we'll be doing that. And then, like I mentioned, once we start the transition to the NCIA, North Carolina Investment Authority, then there'll be some other functions that we'll need to build out as well. So that'll be a part of what we're focused on. And then the final thing is we do need to refresh our market-oriented comp study. So we've had that authority since 2016. We've used it in the past, but it's time to redo that. So we'll be selecting a consultant in the second half of this year, and then we'll get that study going. And depending on when the board is seated versus the investment advisory committee, expectation is that we would come to you all, or if the board is seated, we would come to the board to review that study and recommendations and so on. That's a
question on this. The materials today have a lot of reference to doing directs and co-investments, which I'm very big support. I think it's very thoughtful, but that requires resources. And I'm like, what do you think over the next 2 years as you try and build this? Now, what's the biggest challenge that you're make sure you monitor?
Yeah, I think for the directs, I feel there's lots of deal flow, and we can staff. We need to continue building out the team, right, around the directs. And I feel we have good capabilities which can still be expanded and improved around evaluating directs and co-investments. I think the bigger lift is going to be creating the infrastructure and the support for those directs, right? So we don't really anticipate ever being involved in operating companies, right? We're going to be passive investors by and large. We'll be actively engaged with our general partners and the sponsors. That's important. But we're not really ever going to be set up, at least in the foreseeable future, where we're going to be involved at the operating committee level or sit on a company board. But heretofore, we've leaned heavily on some co-investment in secondary fund managers to help house the co-investments, help with some of the underwriting. And I think we're going to evolve that model. So internally, we've talked about setting up some kind of freestanding SPVs, which would be supported by an administrator, and build out that kind of plumbing and support. I have some experience with directs and some like NewCos for holding securities, sub-investment grade securities, and those can be pretty efficient models. So you set up a valuation agent, you set up an auditor, you have good transparency, good custody, all of that. That's going to be a lift for us. We don't really have that built out adequately yet. We're doing fine with our relationships with the general partners who do secondary funds and do some co-investments for us and help house those and close the investments and so on. But I think that other piece we need to build out.
And if I could jump in, because I like the fact that you're going to be staffing up for directs and co-invests because the leading pension funds in the country are doing the same thing. So most public pension plans are not focused on building out co-invest and direct. So a year before I left my most recent employer, I actually helped build out a co-invest and direct team for a West Coast pension plan.
Mm-hmm.
And they were going through the same things. And what we found was, you may have to pay up for some of these people because there's a war for talent for people with that skill set, which is a different skill set than you typically would have if you're just hiring people just to do privates in general. And then secondly, there was a good appetite of people who were working in funds, particularly in New York, and individuals who did not want to spend their careers in New York and would love to work at a place like the Triangle or in California, the West Coast or something like that. So that provides an opportunity for you. But the other opportunities was that we found a lot of talent in Canada, but I'm not sure that dynamic may have shifted a little bit. But just to put that on your radar screen, and I'm not sure that that's a strategy you want to pursue, but there's certainly great talent with that skill set. But it is going to be a little bit pricey for you, and I'm glad to see you're going to do the market-oriented comp study. That may help you out with that.
I mean, I think we really benefit from the treasurer's prior experience on directs and co-investments, and his willingness to look at the glass being half full. And so that's really helpful in terms of looking at deal flow and getting the right team and retaining that team. I think that's key. So yeah, I think we're all quite excited, frankly. It's new and different things to be doing, but yeah, it's a great opportunity. And again, unlike a lot of other pension plans, endowments, we have excess cash, so we can look at a lot of deal flow that can be accretive to what we're trying to achieve over the longer term without taking a lot of new risk, and it just positions us really well. So yeah,
it's a really important point from a competitive perspective for talent. We actually have capital to do things. Yes, we build the infrastructure to make sure that we can do them on a timely basis. We're getting there, but the market has come our way in a really important way that should drive excess returns, should drive even more opportunity for our team.
Okay, with that, I'll conclude my remarks and transition to the asset classes. So I'll have a couple introductory remarks. The private equity team is going to come up here, and if they don't all fit, they can go there as well.
Lots of seats. Come on.
So typically, when we would bring pacing plan, we would have actual numbers showing what we intend to deploy or would like to deploy over the next 3 years. And this time, though, we're not doing that. We're not going to actually talk about 500 million here, $1 billion there, because we're going into this new world of a new asset liability study, and we need to confirm with the new board risk appetites and things like that. So the teams are going to focus more on give you an update as to how the portfolios are situated, how they think about investing and allocating, and the hope is that it's a two-way dialogue, and you'll chime in with questions, comments along the way, and we'll try to keep the presentations light and airy, and keep it moving. Thank you.
Thank you, Kevin. We had a very fast round robin right before the meeting started, so I just wanted to reintroduce everyone quickly again. So Craig Demko, I'm the Director of Private Equity. I've been with the plan for 20 years now. Just clicked that last week, actually. And prior to that, my background was in public equity. I was a director of equity research at a New York shop. To my left is Brian Bolkar. He will be here for almost 10 years. Next month is going to be 10 years. And prior to that, he was at Virginia Retirement Systems doing substantially the same thing he is doing now. That was 6-7 years. Is that right? Yep. And prior to that, he was an auditor. To my right, Sean Braswell. Sean joined us 2 years ago, right when he was graduating with his MBA from UNC. He has a background in investment banking, as well as he had worked for Bank of America and Credit Suisse in the past. And our most recent addition, Hannah Menachem, she just graduated Duke last month, right? And she actually was working while she was getting her degree at Hamilton Lane, which I'm sure all of you are familiar with that name. An investment advisor as well as an alternative investment shop. And we're glad to have her. And we have another individual that's joining us toward the end of the month who is coming from a corporate pension background. So somewhat diverse backgrounds from all of us. Kevin? You should be able to. Okay. Okay, this slide right here just highlights our allocation on the top left. As of the fourth quarter, we were at 4.8%, roughly $6.1 billion. Underweight our strategic asset allocation target of 6% by approximately $1.5 billion. Rolling that forward to the end of March, it really hasn't changed. We went up in value by about 72 million. However, so did the pension plan in general go up a somewhat equal percentage amount. So our underweight is still approximately $1.5 billion at 4.8% is where we are now. You can see the role in the portfolio. The focus is returns, attractive absolute returns relative to public equity and competitive relative returns. In terms of the sub-asset class allocations, the chart provides a look through of where our money is. Notice the fund of funds, there are 10 of them active in the portfolio, but we're not showing a target for fund of funds. That was never part of our portfolio composition with targets. Rather, it was a tool that was used many years ago, but we still have exposure there. We don't see using those on a go-forward basis. Buyout and growth / venture capital are at the lower end of the allocation ranges. Special situations is above the upper bound. This is largely due to our focus on co-investments. For the past 6 years or so, we put a meaningful amount of capital to work there, and it's performed well and has taken us above that upper band. We'll look to update the guidelines, as Kevin was mentioning, at a later time and explore this with a subsequent meeting, I would assume.
Craig, quick question, because you referenced co-invest. Are you categorizing co-investments all as special sits or like a single asset CV as special sits or in buyouts or growth, wherever they may fall?
So everything that we would do as we have a relationship with the secondary group. Everything that we do in there where we are actually weighing in on yes or no, we're doing the diligence on, that would go into special situations, even if it was a buyout investment, okay? SMAs, which are basically just parallel vehicles with the main fund, we're exploring putting some of those in place. Even though we would possibly assign discretion to the manager to duplicate the portfolio as much as possible, we would call that a co-investment as well. But we would not potentially be making the final decision on something. This is the private equity composition. While we are industry agnostic, except for avoiding real estate and inflation-oriented investments that go to our colleagues, we do look at the construct periodically. we are seeing, as well as in the geographic breakdown, is what rose to the top of our opportunity set over the years. Any questions? Performance. So the top chart shows net of fees time-weighted performance as of the first quarter of this year. It's good relative to the benchmark on the longer term. However, it's below the benchmark on the 1 and 3 year timeframes. While long-term in nature, the lack of deployment on a regular basis and missing vintages over the somewhat recent past is impacting performance, and it's becoming more evident in the shorter term numbers. The bottom part of the chart shows performance on the subcategories, including fund of funds. Buyout and special situations are really driving overall performance given the market values. Over $2 billion, $2.5 billion between the two of them are together. During the past 6 years or so, we did deploy $975 million in co-investments as of year end, 24 co-investments. Thus far, that has resulted in an IRR of 17.6% and a TVPI of 1.6. I'd note that 9 of those 24 are less than 2 years old as of December year end and equal about a quarter of the capital deployed fully. So they're still young, they're progressing nicely so far, but it's weighing on the overall performance right now because they really haven't matured. The bottom chart shows the IRRs on the left, 5, 10, and investment to date. ITD. Inception to date, gosh, sorry. And it's a solid number between 14 and 15%. The PMEs are in the middle part of the chart, and Chris Morris was going to make a comment on that.
Yeah, I just figured we have these PMEs in each one of the asset class presentations, so I figured kind of just level sets with a definition of what you guys are looking at. I'm sure you guys have seen these in the past, but so the one labeled alpha is the direct alpha methodology. That's essentially the annualized excess IRR. So it essentially takes the IRR of the portfolio, the IRR of the hypothetical portfolio using whatever benchmark we're using, and takes the difference of the two. So anything positive there is outperformance. And then the KNS methodology, which is the Kaplan and Shore, that one is represented as a ratio, and it really just tracks the cumulative outperformance over time versus whatever benchmark you're using. So in this case, I think 1.19, it would be, I think of more of like a multiple. So it'd be like a 19% outperformance over the time period that we're measuring.
Yeah, two notes. One is we're showing 2010 and more recent vintages. And we're doing that for each of these presentations, largely because prior to 2010, the private market asset classes tended to be more opportunistic in terms of allocations and wasn't systematic in terms of like what's the strategy, what's the structure. It wasn't really all that well defined. It wasn't as institutional as you would expect a modern program. And so we're using that as kind of the convention. And then the PMEs, we're trying to show it as an opportunity cost. So in this case, versus the Russell 2000 for private equity, it's debatable because we have some, non-US exposure, not a lot. Different time periods kind of drift up into larger cap exposures as well in the US. But we felt that, rather than show page after page of performance, we try to simplify it to just a couple versions, time-weighted IRRs, and then these PMEs. So that's the approach.
In the years prior to 2010, there was a strong allocation to fund of funds as well, which obviously detracted from overall performance. And at a point in time, we were ahead of our skis during the GFC and had to unfortunately go through a secondary process, which locked in some very weak numbers as a result of this, which greatly impacted their earlier numbers. numbers too. So as Kevin said, truly 2010 forward is more of what the current portfolio is being modeled at.
Hey, Craig, quick question on this page. When you run PMEs, do you internally think about them as like adjusting for your sector exposures and like trying to get around? Like I think about, not here, but other institutions that may have 70% technology, and if you use the S&P, that's not really the right index, right?
So this is the straight up Russell 2000.
Yeah.
There are no adjustments that have been made.
But do you think about that, or is that that's something you guys think about internally? How do you think about it?
On a primary commitment, we're developing the capability. I like to take the fund and look at that relative to an index, and then take the individual investments, look at that relative to the index, but then drill down to the GIC. And the real benefit is if you're looking at a sector specialist, you can go to the GIC sub-level. So are they providing value over the public markets for that specific industry? You know, not just on the overall index. And that gives you a lot of insight into the general partner and their value.
And I appreciate it. It's thoughtful, I think.
So you would be thinking that since we have so much exposure to IT to use for a third of the portfolio, IT, PME, and that, you know, if we're able to, the problem would be also we wouldn't be able to, you know, as Brian was saying, we could do the rifle shot, but on a broader portfolio, there could be some funds that are in multiple verticals, and to strip out that performance and property alignment, that could it be done? Yes. Is it something that would add value? I don't know. It's a good thought, though. Would you recommend that?
No, you guys are, what you described, Brian, how you showed it for years, I think is great. The analysis you're doing behind the scenes is also very thoughtful. That's more kind of it. You're looking at it, there's no one size fits all.
Last year, or for years prior, we used to do it for various indices as well, but they really weren't strong. Russell 2 is probably the most comparable. We did it for the Russell 3, the S&P, and the Dow, and the US, the MSCI all world. But obviously those larger indices were also impacted by the Mag 7, right? I think the S&P was about 30% exposure at the time, and the Dow was, or 25. But we actually looked positive when we did it last year off of March as well. So I'm not surprised that it looks solid versus the Russell 2000. So let's see. Strategy and tactics. So primary fund commitments. We want to maintain a pacing discipline. When a high conviction manager is coming back to market, we want to back them. We don't want to time the market and miss a fund that we feel strongly about. We want to rely on their judgment to deploy capital as they see fit. You know, we like them for a reason. It's what they have done in the past, right? So we want to have that as part of our discipline going forward. We want to focus on large commitments to fewer managers where we can likely get better economics with larger commitments. We want to explore cross-asset class collaborations. We've done this with credit and inflation in the past, which has led to a few commitments where we've gotten economies of scale. We've also worked with that was with credit and inflation. We've also worked with global equity to explore some private opportunities that would then become public. We want to maintain our sub-asset class allocations. This should really benefit us in the long term. Back during the GFC, a lot of our peers hung it up on venture capital. And that's when we were saying, you know what, we need to back up the truck because only the best opportunities were going to get funded. And if you look at those funds that we did since that time frame, performance has been pretty solid. So we do want to utilize a barbell approach. Establish larger entities will likely have more direct opportunities for us of scale. But younger funds where we can have a larger percentage allocation should lead to some good benefits as well, and possibly some higher performance because it's easier to grow my opinion, off of a smaller figure. And younger doesn't necessarily mean inexperienced, because these funds can be spin-outs of larger entities. In fact, Dan and I were talking about one somewhat recently, which unbeknownst to me, he was already an LPN. So we're barking up the right tree. And then you see the benefits as noted, enhanced direct deal flow, potential for resource and knowledge sharing benefits, and potentially better economic terms. Direct investments. The main focal point of our strategy has shifted pretty meaningfully over the last 6 or so years to look at more direct/co-investments. And we can do this in various ways. SMAs, separately managed accounts, alongside of our primary fund commitments. This reduces our overall fee structure. And for smaller transactions, it assures that we're going to get some available dollars deployed, that we would have the exposure. Right now, if it's not over a certain size, it kind of really would be de minimis to our overall returns and probably not worth our resources. NC discretionary account, as Kevin had mentioned, the benefits there, we decide on the selection, the sizing, the pacing. And the time we're into looking at an investment, maybe we can participate on setting the price. We can increase our exposure to high conviction managers and look at deal flow apart from our existing managers. As of year end, direct investments, which will just co-investments, continuation vehicles, and SMAs, including fund of funds, look through the fund of funds. Some of our fund of funds managers were, in fact, co-investing it was a separately managed account. We told them we wanted to do this as well. It's about a quarter of the portfolio overall. Implementation. So how are we going to put this to work? How are we going to put our strategy to work? We're going to leverage our own relationships. We're going to be out there more attending conferences and meetings. With a larger staff, we can do more of this. We've been doing it over the past, but just having more people, we can do more of that. We're going to continue cross collaboration internally and be responsive. A quick no is just as valuable as a yes at the end of the day. And, we are going to treat everyone professionally. It's going to pay dividends later. Ryan has been repeatedly been told that, they like working with him or us. He asks good questions, responsive, very communicative. So just being responsive overall. Pay off later.
Craig, recognizing that we're not talking about like pacing figures today, that's going to be deferred until after the asset liability study. But what are you most excited about once that's done? What do you think you have, whether it's market oriented or internal capabilities? And what has been your biggest challenge, and what do you anticipate it being your challenge? How can we help you?
It's actually not deal flow right now. I think the news is out that we're open for business again. It's really digesting all the opportunities that come in, capturing it correctly. We're actually trying to develop a simple template to send out to people that they can come back with something filled out. Is this a deal that we would be interested in? That's really part of it, right? I mean, that's a large part of it right now. And then the second part, Kevin already elaborated on, and it's going to take some time. I think if we had our own internal vehicle with all the plumbing in place, that would be very beneficial, because right now there's a little bit of a time drag for creating an SMA, if you will, to be able to put something in.
I was going to say the one area that interests me is we've seen in the market a lot of general partners where you could call them 1.5 to say 5 or 6 billion, where they're really looking for strategic partners or LPs that they can partner with because they want to be able to provide co-investment, but a lot of LPs can't execute on it. And having the ability to do that pre-syndication really allows you to scale in. And so we can make a commitment of a size where we wouldn't get the same focus in a large fund. So we're looking at a couple of those right now. And so to me, that's really interesting. That allows us to get at least one-to-one co-investment to primary commitment. I think it'll be more. And that's obviously, I think they tend to be more focused on what they're doing, not looking at rolling out multiple funds. So you know that they're really focused on driving returns. I think CVs are really interesting right now. It's evolved the market from, more initially the multi-asset CVs to single asset. And so if you have a general partner that's owned it, that wants to continue to own it, there are some benefits there. We've seen even on the entry multiples. So I think we can leverage into that. And that plays off of our co-investing. And you also get really good diligence. You get to know the GP a lot better. And that's really the best form of diligence, in my opinion. And we implemented the co-investment program before out of necessity to get money to work. And it was the tail wagging the dog. It then led to primary commitments. And so now we have the ability to take what we've done there and say, look, we can be a really good LP from the primary side, plus add this value here. You just have to be able to engage, execute, and want to excel. And if you do that, the GPs want to work with you.
And GPs talk to one another too. And, by our ability to execute in an efficient manner, that's attractive to them. We are a phone call.
One other thing I would comment on is it's a bit of a slow-moving initiative, is kind of building out, expanding ready access to research, right? So there's a lot of generic research. We all get this. But having the ability in deal time to go get deep dive research on a sector, a comp set for a target, that kind of stuff. So the team will go talk to 4 investors, GPs, and so on, to cross-check kind of a view for the underwriting, but to be able to have those research resources available independent of that, I think that's something I want to build out for all of the teams. It's really key for internal management. And I think in other organizations, it's quite typical to have access to expert networks, where again, you can go very deep in a vertical and GIC level and even below. And that's quite helpful. And I think that's something that we do need to build out more. We can kind of add expertise to the team, but we need research services as well.
I would guess that early stage ventures is tough. It's true early stage ventures is capacity constrained and units are running big checks and will be running big checks. I do think that secondaries, I've historically been pretty skeptical of the opportunity set within secondaries, just because I think the funds have a lower cost of capital. They can use a little leverage. They can kind of mark up what they've just bid at a discount.
You mean LP led, not CVs?
LP led, like secondaries. I've historically been skeptical, right? But I do think there's the possibility that is becoming more interesting, particularly for an organization like this that has dry powder, that can communicate very clearly with like an Evercore and Jefferies. It's like, this is kind of what we're interested in, because it seems pretty certain that the endowments will be taxed materially going forward. It's in the House language. I haven't heard that that's going to change. Some at 21%, many at 14%, some 7%. They're already pretty significantly overweight private equity also. And so it's possible that they do need to sell, that they also see an opportunity, kind of like a big bath type moment where they can sell things that they kind of regret owning anyway, or that they just have too much of, that in the second half of this year and next year presents a nice opportunity for those with great liquidity, which you absolutely have. Just a thought.
The one thing that's exciting is our scale and being able to use that to access deal flow. And on the secondary side, I agree with you. It's a specific GP for multi-fund purchases.
Yeah.
You still have a lot of capital out there. I think it's 1.5 times dry powder for the supply. And then you have those levered beta plays on secondaries. They're using leverage. And so they're taking down big portfolios. For me, if you have a high conviction GP and you can come in and you're willing to pay over par and you still get the return, it's a way to establish a relationship. Those GPs say, hey, we would like to do that. So to me, I find it really interesting to go in and selectively try and source those secondary opportunities. And we've been in discussions with GPs saying, hey, if you see anything coming to market, let us know.
Yeah.
Because we would look at that.
That's good.
So on the endowments, obviously everyone has seen the $6 billion from Yale. I heard it wasn't as attractive from various secondary groups. So who knows? I don't know what type of pricing that's receiving, but just pricing on this chart here, LP led the bottom chart. At the end of 22 and the beginning of 23, buyout secondaries were very attractive. There were high teens, low 20s discounts to the most recent NAV. And we had actually deployed some capital there. Today, not so much. It's not really appealing. However, we could start seeing with all the uncertainty going on in the economic climate and maybe the endowments kind of leading the charge on trying to exit, that the discounts blow out some. Well, it's not a no for net forever. However, from what we're trying to do, we want to be more concentrated. It may not play into our playbook, having a very diverse that you're trying to buy at a discount, and that's really a majority of your ups at that point in time, to be explored.
One other final idea, then I'll stop talking, but within growth equity, if you were to see kind of a cohort of 25 companies that keep showing up and that your managers keep deploying into, kind of this identified set of like the next 25 public companies, like SpaceX, whatever, Ramp, Figma, et cetera. There too, increasingly, you can kind of go after those companies directly, right? Like whether it's through Goldman, I'm sure you're already looking at that, but I think that too could play well into your hands, given the liquidity that you have, desire to kind of be very efficient on fees, and just a thought.
Yeah.
I got a little bit jealous of you guys.
We're actually exploring a manager that plays into, I'll call it late growth equity into the public markets, if you will. So they're going to play in the IPO. There's two managers. One is an existing and one would be new. That would offer a lot of investments as well. And that is appealing right now to us. And there's inbounds on just the standalone in those opportunities as well.
Okay, in the interest of time, I'm going to jump you forward just for the last couple of comments on this, Craig, and then if there's questions, and then we'll move on to the next asset class.
Sure. So buyout, neutral or warm, yellow to green. Market dislocation could create some, more attractive entry points. So obviously exploring groups there. Venture capital, we're neutral on right now. Longer hold periods and have really made the IRRs decline. There's been a lot of down rounds that have taken place, so there could be opportunity to be determined. Growth equity, we're positive on, as you just mentioned. Additional capital due to longer holds may be required for continued growth, and that could happen as well as at more attractive valuations. Secondaries, we already talked about LP led. The discounts aren't that great, so we'll say negative to neutral. But the neutral part of it is we could potentially start seeing some larger discounts. GP led, we're positive on. I mean, truly, that's kind of like underwriting a co-investment or a direct investment itself. Love to have your feedback on distressed. My take is you're buying noise, maybe it's a carve out of a larger entity, and you call it a complex carve out because you really have to rebuild whatever you're buying out, new management team and things of that nature, or it's just distressed. But it's not a good company. We have tried it in the past. The performance has not been that great. I'd rather let the credit guys look at those types of opportunities, but, you know, love to hear your thoughts.
Craig, the one, so I agree that on the corporate carve-out, Bain had a good piece in their annual PE report about the lack of performance of corporate carve-outs over the last 15 years. So if you haven't read it, I recommend you check it out.
And then apart from everything on this page is the direct investments. We've spoken a lot about that. That will be a cornerstone of our strategy going forward.
Craig, quick question on that. You know, how much of the portfolio do you see in direct investments over time as the team builds out? And then what about your process to get things done? I know you mentioned the structural thing of having the legal documents in place or the structure in place. That's one thing, but what about the ability to move on a timely basis, you know, 2 weeks or less for an opportunity? Because, you know, these things come fast and furious, and sometimes you just don't have the timelines you'd like. And so I'm curious how you guys plan to navigate that.
We've never missed a timeline. So you have to be able to execute, and sometimes it's two. We're doing one right now, potentially multi-100 million with a 2-week timeline. We did some key work. One of the keys was we originally established a program with Ares because they enabled the legal execution in a commercial time frame, which is really the key. And then we would diligence ourselves. We would pull them in and do it hand in hand. So that helped and does help on the timeline for the execution. The diligence, it really comes down to if we can't get comfortable in the time frame, we don't want to be an impediment with the GP. So we'll say, hey, it's best for us to step away. You know, we want to be a value add partner. And then, as you know, there's repetitive conditioning. So you've looked at a lot of different deals. Right now, we've looked a lot at insurance distribution. So when you see something initially, there's a lot of boxes you can check to pretty quickly say, hey, we can move forward on this. And then really, you bring up a really valid point. If we had more than one person, or we had a couple people, we could divide and conquer. You don't want to rely solely on the GP, so you want to go in and test the model, stress test it. We do our own scenario analysis. And so then a lot of it is, what is our internal process to say, hey, guess what? We don't want to have so much formality that we can get this done in a couple of days. So you highlight items that have definitely been forefront minded. But we will step away. We feel like we will just, you know, bring a negative dynamic to the process. But we've never had to do that.
We've had two in the hopper at the same time, and they were both fairly short timeframes. So it's divide and conquer, and the hours were put in to get it done.
Thank you all.
Will the real estate team come up? And Troy, we'll sit here and you can run the slides.
I'm not going to do that.
Okay, fine.
Do you want to sit here?
It's just the number. And keep type with Troy over there.
Control L.
What's that?
Yeah, I know. Do the math.
What is this?
Control L.
I think it's.
By the way, I did test negative for COVID, flu, strep. Good old fashioned, you know, spring allergy, head cold kind of thing. But forgive me if I'm not super dynamic in my presentation today. My head's swollen from Dayquil a little bit, just to get me through the presentation. But, and forgive me if I'm just reading my script a little bit, just I'm trying to get through it. Start with introductions. I'm always impressed with the level of talent that we have here in the investment division collectively. And our team is no exception to that. And just to save my voice, I'm gonna let them introduce themselves.
Nice to meet all of you. Tessa Tanis, like I mentioned earlier, just rejoined the team last week. was with the team from 2015 to 2018. Troy and I have a long history, worked at Highwoods Properties office REIT here in Raleigh together for many, many years. He recruited me over here the first time, and apparently I can't get enough of him, so I'm back. Really happy to be back with the team. My background is spend beginning of my career with REITs, both retail and office. Have spent some time here on the institutional side. And then for the last 6-7 years, I went back on the private side, working with private equity on the GP side. So say I went to the dark side, and mostly with multifamily, a little bit of industrial retail. And most recently spent a year with Duke University, helping the endowment with a lot of what we're talking about today about, ramping up their direct and co-invest abilities. So working with that team, and happy to be back with this group.
I'm Casey High. I'm a portfolio manager. I've actually been here over 13 years. I know what you're thinking. I started when I was 7. I've spent a lot of time actually in different asset classes. I've spent a little time with Jeff in fixed income, a lot of time with Rhonda in public equities, found a new home in real estate in 2021. So just happy to be, here. Working with all the different asset classes and collaborating.
Chris Ward, I'm the investment analyst on the real estate team. Similar to Casey, I joined in 2013 on the operations team. Worked with Kathy and her team for a number of years before joining the real estate team in 21 as well. So excited to be on the team and looking forward to.
Our real estate portfolio is currently made up of 2 distinct portfolios, core and non-core, each with their own goals and objectives for the portfolio, for the plan, that is. Core is focused on durable cash flow, long-term hold, and inflation hedge characteristics. Non-core, which consists of value add and opportunistic subsectors, is more focused on growth and upside, more of a buy it, fix it, sell it kind of portfolio. Slide. And feel free to interrupt me as we go with questions. Currently, real estate has a legislated cap of 10% and a target of 8%. All that subject to change as we go through our asset liability study and evaluate our plan going forward. 5% of that 8% is for core and 3% is for non-core. We're roughly at 6.5% overall. We're at target for core, but materially underweight for non-core. On an absolute dollar basis, our core portfolio has remained fairly steady over the years due to the long-term hold nature of that portfolio and most of those investments. The non-core portfolio, however, is primarily closed-end funds that return capital to us, and that has burned off over the last 7-8 years. And that's where our material underweight currently resides. If you notice on the left-hand side of this slide, we have in our core portfolio 19 funds and 57 funds in our non-core portfolio. 19 in our core and 57 in our non-core portfolio. And that's an important point that I'm going to circle back to later in the presentation. This chart compares us to a simplified benchmark, not our actual blended benchmark for core and non-core, which is a little more complicated. For example, our benchmark for core is 80% of the Odyssey index and 20% global REITs. Odyssey, if you don't know, imagine you do, but just in case, is the open-end diversified core equity index that most plans use as their core benchmark. I would characterize us as benchmark aware, not necessarily benchmark driven. And I would say I like our positioning here with regards to residential and retail, but would prefer slightly more industrial and less office overall. Our large exposure to other in non-core is primarily large mixed-use development projects that we have. Slide. Coastal or the small markets tend to be the most liquid markets, and that's where we have most of our exposure, not in the heartland. I would like to see us have more exposure to the ex-US markets, and that's something that we'll be evaluating as we evaluate policy and our asset liability study. Slide.
Troy, that you highlight data centers later as like is that is within industrial in this classification or other?
Not in this. And this is just traditional industrial?
Yeah, I think data centers probably would fall into other right now.
Yep,
Chris?
that's correct. That's correct. Data center in this graphic falls into other.
Thank you.
We currently do not have a whole lot of exposure to data center. We have some through investments with Blackstone, but that's an area of focus that we're looking at. We'll talk more about that later. Slide. This is our core portfolio performance and PME analysis. Our core portfolio is doing what we expect of it, which is producing durable, consistent cash flows. Valuations may move up or down, as the case is currently down, given where the recent rise in interest rates, but the portfolio consistently produces cash flow as expected and serves as an inflation hedge, which is the purpose in the overall plan. Slide. Our non-core portfolio. This slide is kind of hard for me to look at, the negative performance that we have right now compared to the benchmark. For years, our non-core portfolio was a source of pride for us as it consistently used to produce 400 to 600 basis points of alpha. As our exposure has burned off, as we've gotten money back in our non-core portfolio, our non-core portfolio is currently full of tail-end fund positions, back to that 57 that I alluded to earlier. Tail-end positions that are beyond the life of the fund in the quote-unquote liquidation phase. Often, these are not funds that were bad investments on an inception to date basis. Even good funds will have problem assets that they hold on to in hopes of turning them around at the end of the fund life. Of our 57 non-core funds, only 5 are in the investment phase, 8 are in the harvest phase, and 44 are in the liquidation phase. Those 44 represent approximately 25% of the non-core portfolio AUM. This distribution should look more like a bell curve. This gets back to vintage year diversification, which is very important. Lack of this vintage year diversification and a meaningful underweight to industrial over the last 5 to 10 years has hurt us. However, even with this recent underperformance, if you look at the PME analysis, this portfolio has produced meaningfully positive PME. Slide. When I describe our plan, when I'm out at a conference or talking to other folks, I like to use this term, concentrated diversification, which is kind of oxymoronic, but it really fits, I think, what we're trying to do, which is build large positions with sector-specific managers, which provide us more control, lower fees, and better alignment of interest, and collectively as a whole provide us the diversification across our portfolio. This scale with the individual managers allows us to capture top-tier managers, and it also helps us reduce fees on committed but unfunded, reducing the J-curve and reducing gross to net spread. Our focus to date has been on separate accounts, but going forward, it may also take the form of direct JV investment or platform level investments. I believe strongly that asset allocation decisions are perhaps the most important decisions we can make. And our focus on higher control structures allows us more control over what our pie chart looks like and a greater ability to change it when we want to. If you're in a portfolio of closed-end commingled funds, you really can't change what your pie chart looks like when you want to. And being able to make those changes to your pie chart is just very important. We're well covered in the traditional sectors, and our focus is currently on complementing it with more niche or subsectors of the traditional sectors, such as self-storage, manufactured housing, single-family rental, student, senior housing, land development, small retail, data centers, marine and cell towers, et cetera. Portfolio premium is a big part of how we believe we can provide outperformance on a risk-adjusted basis. Portfolio premium, I assume you understand that concept, but just for example, is defined as when you can buy individual assets, just pick a number at 6% cap rate, and then sell a portfolio of those assets at a lower cap rate, 5.5, for example. This cap rate compression or premium creates significant value. Other large institutions that are not willing to do the work, they're not willing to chop the wood, will pay this premium so they can quickly get exposure to a sector and scale. Our self-storage platform is a great example of this. Our focus there is acquiring high quality, newer, stabilized assets, no value add, no opportunistic, no ground up development, but stabilized assets in one-off acquisition strategy from the fragmented ownership across the country. These are otherwise core assets with resilient, stable cash flow. With these small check size investments like this, you can capture portfolio premium and turn that core level risk into opportunistic level returns without adding risk. But this is only possible if you can capture a good manager that has a national footprint that can give you that speed to scale and do it relatively quickly for you. And you can only do that by making meaningful commitments to capture these managers. Slide. There's a lot going on this slide, but basically this is where the real estate industry is overall, kind of a snapshot. This is the takeaway is there's been meaningful cap rate compression. Cap rate spreads have narrowed considerably since interest rates have risen on the right-hand side of the slide. But that correlation is weakened over time, and we see this as an indicator of stress in the market. A tough time to be a levered owner, but a great time if you have the dry powder, which we do have, to invest and take advantage of the distress.
So just a comment on that page. I think we look at it versus the 10-year rather than SOFR, but it's the same exercise. I think in real estate, having an opinion on this in 5 years is one of the most important things you can do. Because as you know, spreads, as you pointed out, rightly so, spreads are incredibly tight right now, but they do vary over time. And whether they're 100, like take multifamily, whether they're 100 or 225, which is the 30-year average, is a big difference in your returns 5 years from now.
Yeah, for sure. Next slide. I'm not a big fan of this slide or slides like this. This slide implies that you can characterize these sectors on a simple, positive, neutral, or negative basis. You may have read that college enrollment is off nationally by 3 to 4%. Colleges are closing at record numbers, and that demographic headwinds will challenge universities for years to come. This is all true, but it's also true at the same time that flagship schools in the Power Four conferences are benefiting from this flight to quality and supply-demand imbalances. Enrollment acceptance rates are lower than they ever have been at these Power Four conferences. I would tell you that I'm not a fan of office and haven't been since well before COVID due to the hamster wheel of CapEx spending, but I also may recommend office investment in the near future. I can tell you that retail is a strong sector right now after a decade of the retail apocalypse, but then tell you that I want to sell some of our retail holdings. When it comes to real estate, there are always exceptions to the generalities. Having good partners that can execute with a rifle shot approach is just so important. Good managers can make you money at any point in the cycle, and bad managers can lose you money at any point in the cycle. But the one thing that's kind of true across the board right now is that new supply has tailed off in most sectors, some more so than others. The supply-demand dynamics are setting up for strong rent growth in most sectors, except perhaps office. Office will take a few more years to find its equilibrium nationally. Caution has turned to curiosity with regards to office Blackstone has begun dipping their toes back into office, which is sure to lead others to follow. So, everything that I could tell you on this slide, we could pick apart and find instances where there's exception to these rules, but this is generally how we see these sectors generally. Any questions here?
How much development exposure do we have today?
Not a lot. We used to have more when I started here 12, 13 years ago. Our portfolio was primarily closed-end commingled funds, but we've moved over the years more towards these separate account models. And as we've done that, those have primarily been acquisition strategies. So we have less exposure to development, but we're working to change that. We have a very large project in Apex, a mixed-use development project that will help. We have a little bit of land in Bellevue that we're contemplating developing as well, but we have less than what we used to.
Yeah, we had a program at one point that did develop to core, right, in multifamily.
Yeah.
And we like that kind of as a longer term play where we were willing to take the development risk, had a very high conviction in the developer, actually owned a piece
Yes.
of the developer. And but we wanted to thoughtfully build out our core exposure.
Yeah,
so that's one of the reasons. There's
which
others.
we did, and
Yeah.
that's now part of our core long-term holding. But I would say that I feel like our portfolio is probably 70% core right now. I feel like it's time to rotate more towards the non-core, and it may be time to start looking for another build the core opportunity cycle for multifamily and go through that cycle again. I would like to see our core exposure come down a little bit, and it feels like it's time to rotate into non-core opportunities there. Any other questions?
Comment for what it's worth. I would agree strongly. I think the current liquidity situation in real estate, I would put forth as the worst it's been since the RTC days right now. So you have just phenomenal ability to drive terms if you do JVs or direct deals because nobody has liquidity.
Yeah.
Right.
Yeah, on that topic, our separate accounts, the terms and fees that we have collectively are just phenomenal. I'm not going to quote them in a public setting, but I can tell you some of them offline, and you'd probably laugh at the terms that we have. They're just really strong, and you only get those by building these large positions. I mean, real estate generally, think co-invest. Real estate's not like private equity. It's not zero fees, zero carry. It's generally half fees, half carry, and on average, weighted average across our separate accounts, we're at that level or better on our fees and carry. So it helps to have that scale to drive those terms down for sure. Last slide, this is kind of just an appendix slide. This is our overall pie chart. Previously, we'd shown exposures in core and non-core, but this is overall real estate. And the chart on the right gives an example of an idea of the exposure per sector that we have in our what I call our higher control structures, which are separate accounts, platform level investments, direct investments, things like that. Any questions?
So obviously the entire industry has gone through a valuation reset over the last 5 years. That's all you're seeing in the performance numbers. As you look through the portfolio, particularly the large holdings, do you feel like they're fairly marked at this level?
Yeah, I do. I think when you have these separate accounts as opposed to being in one of the open-end diversified core equity funds, I'm not sure that those Odyssey funds are fairly marked. I think that they have a ways to go, but they different. I don't want to disparage them, but they have reasons for that. And with our separate accounts, we have more control over that, and we can look at that more closely and make sure that they are marked fairly. And I would say that in any of our separate accounts where we have exits, we almost always are exiting at a higher number than where we've been holding them. So we look at that very closely, and I believe our managers do a fair job of marketing its assets. Yes.
1% of the portfolio in REITs.
No, it's higher than that.
All right, that's 95 bips or whatever on one of the prior slides, but.
About 8% overall, I think.
All right. Okay.
Yeah, so within.
No, the total, not the real estate.
Oh, I see, yeah.
Do you have would a dedicated REIT manager fall within this portfolio? Or?
Correct.
It would, okay.
Yes, we use BlackRock.
Yeah.
We have an active strategy with them. We initially it was 50% active, 50% passive, but they were doing such a bang up job producing alpha consistently for us. We went 100% active.
Yeah. Are you excited about the opportunity set within Publix?
I would say I'm neutral on Publix right now. It ebbs and flows, and it's really driven by, interest rates. If there's perception that interest rates are going to go down, REITs will run, and then it just runs the opposite way. And that's another part of my high level strategy that I've been thinking about. We've been thinking about for years is just being able to tactically tilt between public and private, and positioning in our portfolio the way we have, where we have control of the exit and we can turn the drip on or off so that we could rebalance on the margins between public and private without blowing up any one of the individual managers' business plans, I think is important, because there is real opportunity to capture and create, it's not arbitrage, but low risk alpha by moving in and out of public and private. And most people can't do that because they can't get to the liquidity. But we have a much easier path to doing that because of the way that we're structured, primarily in higher control structures. And that's a big part of the reason why we've been moving that direction.
Most recent REIT allocation was 14%.
Within real estate.
Within real estate, yeah.
Can you tell us a little bit about how you collaborate with the credit folks? Just given what Dan mentioned before, the opportunity set right now, the opportunity between sort of nexus between real estate and credit right now, I think is pretty interesting.
Yeah, it definitely is interesting. Now is most definitely a time to be looking at credit. But I would say historically, since I've been here for a long time in the low interest rate environment, debt was dilutive to our portfolios because just rates were so low. So we were not doing a lot of credit investing. But that cycle has turned with the rise in interest rates. Now is most definitely a time to look at interest rates. And we are holistically as a plan looking at credit. And we're thinking through, I don't know if you want to speak to it, but.
Yeah, I can speak to it. So we're anticipating one of the outcomes of the asset liability study is that there'll be some restructuring. And one will be to create a freestanding larger credit allocation, which will cover, amongst other things, commercial real estate mortgages. So Ron and Ming, in particular right now, actually are fairly advanced in terms of looking at a couple of platforms of significant scale in anticipation of where that asset liability study will go. The thinking is for real estate that it would be predominantly equity oriented going forward. And, there's kind of the old classical approach of debt, equity, public, private, have the quadrants. But I think, again, this notion of competition for capital going forward, it's going to be imperative that big components of real estate are going to be competing for capital against other higher returning sources, right? So or targets. It's not to say that the team isn't looking at a few things kind of in the hybrid space, like Bird, yeah. And so there's some deal flow around that, and they may take advantage of that, on a selective basis.
I'd chime in as well to say over the last 6 to 14 months, we had the most interaction between real estate and opportunistic fixed income, meeting managers internally about credit opportunities than we've had in the prior 10 years. So after the rate rise and the issues in real estate have reared their heads, I'd say we've had more collaboration than ever before with our teams, similar to how Craig mentioned how our team has worked with private equity at other different times. So we're hand in glove with the real estate team right now.
Which is a great segue.
Thank you all. Thank you all.
You want to take 5 minutes?
We can do that. All right, let's get back to it. Over to Donald and Ming.
Good morning. It's a pleasure to have an opportunity to speak with you about something that's near and dear to me, which is the opportunistic fixed income portfolio. I'm joined by my partner in allocating, Ming Chu. Ming has been with the plan for about
a year and a half.
And has a pretty extensive background. Tell a little about your background.
Yeah, I started my career at Lehman Brothers as an analyst on their fixed income and hedge fund desk. Later on, transitioned my career multiple times, including being a mutual fund manager in China, running their QDII fund, as a portfolio manager for a global macro fund based in Charlotte. I transitioned to become an asset allocator about 5 years ago in 2020. I worked for a German bank out of all things, and then as their corporate pension plans portfolio manager based in Luxembourg. So I joined North Carolina Retirement System about a year and a half ago, and I've been very happy working with Ron on the fixed income portfolio and the inflation sensitive portfolio.
And we'll segue to start our presentation. This will be the first time I've had a chance to present for most of you, but I've been with the plan for about 16 years. And typically, we do deep dives on a quarterly basis once a year to the Investment Advisory Committee. And this slide deck is a subset of that deep dive. So there might be some things missing, so feel free to jump in at any time, and hopefully we can fill in the gaps with a little commentary. But typically, this is where we start. We don't want to miss out on the important 5 things for the portfolio for credit. And that is to one, to have attractive absolute returns, competitive relative returns, provide a diversifying source of returns for the broader pension fund, capital preservation, and deflation protection. Not necessarily in that order. I think the most important one is capital preservation. I think we've been able to demonstrate that over a long period of time. And in weaker moments of where the market, we've experienced lower drawdowns during those times, and we'll move forward. This slide shows the building blocks. On the left-hand side is a high-level view as to how we think about our portfolio construction at a high level, very, very high level. On the left-hand side, traditional corporate credit is more of a non-investment grade, high yield, leverage loan allocation, more liquid strategies, loan only. We also have a subset of managers that focus on distressed credit. More over time, it's more on a drawdown basis. We have a large allocation to open-end credit funds where they may have the ability to buy CDS as protection or short exposure, but pretty much long bias, more somewhat market neutral. And then the bottom side is special situations where there's a dislocation in the marketplace or a manager that has some sector expertise or something they're really, really trying to take advantage of, or we allocate to that manager on a one-off basis. And so on the right-hand side shows a lot of the building blocks of each of one of those. So right now, corporate real estate debt is a building block that we're going to be looking more into in the future. Direct lending we've had for 12 plus years in our portfolio, where a lot of other pension funds are now allocating to those spaces. But just wanted to give you a high level sense of what we have in our portfolio. Next slide. This slide shows our weighting in the portfolio as of 3/31. A lot has happened since 3/31 within the marketplace. One, we've allocated as Kevin mentioned, as part of our rebalancing program, we allocated north of $500 million to our asset class. but that capital is yet to be deployed because a lot of that capital is in drawdown-oriented funds. But as of 3/31, we were underweight our asset class by a little less than 70 basis points. And we're as we get closer to our target weight of 7%, we're monitoring that, and we have levers in which if we go over our 7.5, we have some levers where we can lower our weightings or look at some of our managers with assets that are closer to par or trading above par where we can do those strategies. And again, these are our policy target weights. They're very loose, but very, very loose to give our team the ability and discretion to allocate as we see fit as the opportunity evolves over a cycle. Next slide.
Hey, Ron, quick question on that. Of those 38 funds, like, how would you roughly describe them as, actively investing versus in wind down mode?
Yeah, that's a good question. In our deep dives, you would see where we have probably 12 fund managers in our portfolio that are the bulk of what it is that we're doing. And then with those 12 fund managers, you probably have close to maybe 18 funds with those managers. So in our portfolio, we take advantage of a commingled relationship, or we structure these SMAs, or we have an opportunity to co-invest alongside those GPs, but in a very efficient structure. So of the alternative asset classes, this portfolio has the most concentration or the least number of managers. And we may have a number of funds with those managers, but we try to use our scale and ability to work with managers, so in a more concentrated fashion. Next slide. I'll start with the top left. Over the last 10 years, you can see our performance relative to the benchmark over 1, 3, 5, 10-year periods, been positive relative to the benchmark for the most part. One period that I'm really fond of, again, I started here 16 years ago. There's a 15-year slide where we've generated 7% rate of return, and the relative benchmark of that period is only 3.5. So we've generated meaningful outperformance during that time period. And as we want to look at the benchmark next, the benchmarks really try to show where we can invest and think about things. So we have Credit Suisse Leveraged Loan Index and high yield as about comprising about 30% of our portfolio. And then given that we have a meaningful amount of hedge fund exposure, open-end fund exposure, we wanted to make sure that relative value and distressed funds comprise the other meaningful portion of our benchmark. We're benchmark aware, as others said, but we're not necessarily focused on benchmarking as we allocate to different fund managers. We really want to look at how that manager can eliminate the left tail risk. I don't really worry about the benchmark's left tail risk as on a day-to-day basis. I really worry about the underlying manager's ability to minimize left tail risk for us. And if you looked at our performance on a year-by-year basis, you would see when many of the indices have meaningful drawdowns, our portfolio did not suffer that same type of drawdown. Whereas also, in a return or on a normalization year where CCC index may have a high pop, our portfolio may not pop the exact same way because we're not as focused on the riskier side of the portfolio. We typically have senior secure credit, we're senior in the capital structure, a lot of low risk stuff in our portfolio as to how we think about risk. Kind of skipped a little bit of the performance stuff on that slide, but you can look at it. If you have any questions, feel free to answer or ask them at any time. This is at a high level how we think about allocating over a cycle. Of course, every single product type has its own credit cycle. Everyone has its own credit cycle, but at a high level, when spreads are wide, we want to be allocating to more of our distressed, our dislocation-oriented managers who can capture opportunities in the more liquid markets pretty readily or pretty quickly. But over a cycle, we're really allocating to performing managers that aren't taking a ton of risk. And then when credit spreads are super tight or there's less opportunity, we really want to focus on higher quality, low risk mandates, low left tail risk type of things. And we don't really know exactly where we are, but we're guessing. Let's say we're in an environment as that blue slide or the blue dots on the page represent where spreads may be widening on a go-forward basis due to potential increasing in default rates for certain corporates or potential increasing delinquency rates, and as you see in autos and other areas of the credit markets. And so from the date in which these slides were made, I think a lot of our dates started at like end of March 3/30 or 3/31. We've had almost a credit cycle between where spreads blew out in early April and then they've continued to collapse. So it's more of an art than an exact science, but this slide kind of demonstrates how we think through things. Next slide. And how do we add value relative to our peers and benchmarks? I'm gonna start in the top left when I'll do a clockwise approach. Number one, we try to use our scale, our structures, and time horizon. Being a long-term investor, we try to use that to our benefit through the things listed in the top left box, whether or not it's negotiating, whether or not it's partnering, or just trying to find opportunities where other investors think super narrowly, where we say, hey, you know, we have our own unique set of return targets. Your commingled fund may only do 15% targeted rates of return. You know what? We're willing to lower that return threshold and to pursue something 200 bips lower if you can cut off the left tail or if there's more collateral on that particular thing. So that's the top left box. Top right box is we talked about credit cycle positioning as well. That's how we think about adding value over the time period. In the bottom right, we try to find high quality managers that are allocating thoughtfully. And if you really break down our performance in the special situations book over a short period of time and a long period of time, we've driven outperformance, and that has been a very, very strong contributor to our long-term success is manager selection, especially in the special situation category. And then the bottom left, security selection, although we're not necessarily selecting securities internally today, we do work with our managers, whether or not they manage a co-investment account for us or a separately managed account for us, where they can overweight specific names based on the opportunity set of that name. Where in the commingled product, if it's an open-end commingled product, a manager may only be willing to have 50 bips or 1% allocation to a name that may go through a restructuring or a 2-year process, where in those situations, we're willing to take a 5, maybe a 7% allocation to something that's illiquid, especially if the longer-term prospects for that opportunity. So those are the 4 ways that we add value relative to our peers and benchmarks. I think we've been reasonably successful. This slide has a lot on it, but to summarize it, credit spreads are pretty tight. This slide deck also shows where credit spreads have been over the last 4 to 5 years. It's been all over the place, and even it's been all over the place since March, in which this slide deck shows. But although credit spreads have been all over the place and they have recently tightened in, we still feel that credit is a really attractive asset class. If you look at credit spreads on a percentile basis, it's actually kind of rich for asset class. But if you look at yield to maturity, which the next slide shows, credit is actually still really, really attractive. On a percentile basis, we're probably in the top quartile best opportunity set for credit over its lifetime. So on a yield to maturity basis, our directly originated private credit opportunities are still, managers are able to originate on a forward-looking basis, double-digit rates of return on a forward-looking basis. Recently, we allocated to a fund manager focused on CMBS and RMBS, and unlevered, we believe that manager is going to make 9 to 10% rates of returns for us between buying credit at a discount and then having a pull to par in maybe a 2 to 3 year period. And that's on an unlevered basis. If they're able to put a half turn of leverage or a turn of leverage, we're able to actually generate closer to 12 to 15% rates of return on the marginal dollar that we recently allocated in that space. So this also highlights as well the green arrows. If you look at them, a lot of the stuff we like are more in the structured credit space. So if you look at structured credit relative to the underlying cash instruments, structured credit has some relative value on the margin relative to the underlying securities. Next slide. And this at a high level qualitatively sums up how we think about the marketplace. At a high level, again, we like structured credit, CMBS, ABS, commercial real estate debt. It's pretty attractive for us at a high level. As we mentioned, we've been working with the real estate team. We've been working with others, Ty over at Multistrat, to really parse through opportunities in that space. And then most recently, a lot of our capital, the way we're allocating capital on the marginal dollar, we've been leaning in on short duration opportunities where the manager knows that there's a catalyst in the next 2 to 3 years where there's a refinancing opportunity. Maybe you're buying credit at 80 cents, 90 cents, but if you can pull to par in a 2 to 3 year period, that's a really attractive yield to maturity opportunity, even though the spreads aren't that great in that space. And at the bottom, we're really trying to guide our managers to stay away from cov-like debt opportunities, especially if they're not a meaningful position in that capital structure. As you've been reading and hearing about, there are a lot of liability management exercises or basically out-of-court restructurings where if you're not driving that solution, you really can have collateral leave your box, or you wake up, you thought you had a low LTV loan and you wake up, you actually had a LTV loan of 100% because all the collateral you had moved away. So we're trying to take advantage of that opportunity, but we're also trying to not be a casualty of that opportunity in the marketplace. And finally, historically, we've accessed the opportunity through SMAs, and we don't see that changing on a go-forward basis. I think we have some commingled exposure right now, but I think on a go-forward basis, that commingled exposure is going to go down everywhere where we have a separate account, and we're able to jigger that separate account to our unique status. We've actually been able to outperform the manager's underlying commingled vehicle meaningfully. And on a go-forward basis, we'll probably be doing more co-investments, but still in the SMA format or fund-to-one format. And then there is a little blip on the right-hand side. I think on the go-forward basis, under with additional staffing, where there may be an opportunity for internal management. Do you want to?
Yeah, I can address this. So this is, it's not on the near-term horizon, but it's definitely part of our planning as we think about building up the team and capabilities. We've had a long, good, successful track record with investment grade. We have a high-performing credit underwriting team. They use their own kind of experience and expertise, but they supplement it with external resources like covenant reviews and sector specialists and things like that. I think with sub-investment grade, the expectation is we'll trial that internally and we'll add to our credit underwriting team, but also use some fundamental equity research, which we brought on recently, and we'll expand. And I think for us, we need to get some additional external resources to support the credit research. But the idea is to kind of start with probably a small dollar amount, build it over time, make sure we're fully, comfortable with it. We do have actually more infrastructure as it relates to credit or opportunistic fixed income, because we also have a managed account platform. So we launched this back in my first tenure for SMAs for hedge funds, including on the credit side. And we still have one manager on it, I think, on the credit side, two, thank you. And so that gives us infrastructure that we can use to set up some of this, and then also utilize the resources that it's FRM Man, that's who runs it for us. And they have some resources that we can import as well. So this is, again, it's not happening tomorrow. We need to build out the team and some resources, but this is an area where we think we can take advantage of an adjacent opportunity.
Just a comment. 8.57% annualized over 5 years for hedge fixed income is a lot of alpha, I have to think, embedded in that number.
Yeah. Thank you.
Good job.
I would give a lot of credit to Ron and the team, current as well as prior team, around being thoughtful, using series limited partnership agreements as well. So we like the flagship fund of a, sponsor, and then doing multiple sleeves alongside where we can take advantage of opportunities in the market that are identified by the manager or by the team and have that flexibility. And I think some trigger funds as well have proved to be super timely and super effective. So I think this has been a really good asset class over the years. Yeah.
Just because I can't help myself. Now you've raised the bar. You got to clear it again. No, but in all sincerity, this of all our asset classes has evolved the most in the last 6 months, the opportunity set. And the amount of work that represents for you guys is not lost on, I think, any of us. So thank you for that.
Thank you for being supportive.
All right, we move on to information sensitive.
Yeah. Andy, you want to come up?
This is also the other asset class that we collaborate with daily. Our team also manages the inflation sensitive portfolio, and some of the thought processes that we leverage in opportunistic fixed income poured over pretty relatively for the inflation sensitive portfolio. So I introduce Andy as well.
Sure. So, I'm the one with the 35 years experience, and I can't hide it. I don't have Casey's hair. So I've been focused on transactions since, joining the project finance group at Solomon Brothers during the John Goodfriend days. So that's really been my focus. And I'd say, 80 to 90% of my time here has been on the co-investments and direct side, building out the portfolio, but also the process that we're following. And I would just say that, in doing that, realizing that we're comfortable in certain areas and we have to be disciplined enough to raise our hand to say we're not specialists in certain areas. My background is power, utilities, infrastructure, energy, and agriculture, but not mining. So if we find something there, it's a higher bar. It takes a little bit, it's more difficult to process something like that. But we're putting in a process to the point where we're trying to make sure we don't have loss ratios any worse than our managers. Some of our best managers are in that 3 to 6% range. We don't want to have line items in this space that go sideways. So we're taking as slow of approach as we can. Someone mentioned, 2 weeks turnaround for a deal. It's more like 2 months. We have time, but we can only do so much with the resources. So we'll get into that as we discuss it. But I've been here for 4 months, and it's been a fire hose from day one. So
welcome in. All right. So again, we typically start with the foundation. What's the role of the asset class for the pension fund? For the inflation sensitive portfolio, the role has been to provide inflation protection, attractive absolute returns so that the opportunity set can stand on its own, competitive relative returns relative to the actual risk that we take. We want to earn a premium to that, providing diversification to the broader plan. And lastly, we want to provide liquidity to the plan whenever the plan is struggling with dynamics from inflation. And if we look at over the past 5 years and the return of capital over the last 5 years, we've generated positive liquidity, meaningful positive liquidity when the inflation environment took off for the broader plan. But that's, again, this is a subset of a deep dive, and there's meaningful slides that we're not going to be able to share today. But I would argue that we've definitely delivered on some of that goal of the role in the portfolio. This slide, again, shows the building blocks and the goals. The building blocks are TIPS, bank loans, RMBS, CMBS. On the liquid side, commodities as well. We typically have leveraged some credit exposures in our portfolio. And then on the more illiquid, the box at the bottom, we typically would look at infrastructure funds, infrastructure opportunities, whether or not it's in the energy space, like power, mining, or drilling, or and other infrastructure like ports, things of that nature. Ag, timber, these are the building blocks historically for the pension fund in this asset class. Next slide. This slide deck shows our allocation as of 3/31. As of 3/31, we were short of our target weight by 1.3%. Since then, we have allocated approximately $700 million to our inflation-linked bond portfolio. And our inflation-linked bond portfolio is like a staging portfolio. It tries to deliver the liquid, long-term rate of return without a ton of risk. And we like this inflation-linked bond portfolio relative to TIPS, because TIPS have a significant amount of duration built into it. And so years ago, we developed an SMA with a couple of our managers to kind of take away the negative aspects of TIPS and the long duration elements of that portfolio to still deliver enhanced returns like TIPS, but better without all the left tail risk. So in the last 3 to 6 months, we've allocated approximately $700 million to the inflation-linked bond portfolio, and we're narrowing the gap for the broader inflation-linked portfolio relative to its target weight. Next slide. This slide shows the performance on a 1, 3, 5, and 10-year performance. Our longer-term performance is closer to inflation, but our more recent years, we've actually outperformed inflation very meaningfully, as indicated by the absolute rates of return in the top left segment of the portfolio, and then also demonstrated by the PMEs off to the right. And I think we use the 40-60 commodity TIPS allocation as the opportunity cost of capital over a long period of time. If one were to use a 60-40 commodity TIPS, would actually be better, but we tried to use something so that you didn't think we were cherry picking or using weaker performance benchmarks. And if you look at the inflation-linked bond portfolio on the left-hand side, or how the components are broken down on the left-hand side, you can see the performance over 1, 3, 5, and 10-year period. And then the bottom row, real assets and diversifiers, that's also been a meaningful value add for us since, I'd say, 2012, when we started allocating to things outside of commodities, looking more into secondaries, looking more into infrastructure, ports, all sorts of things like that. That's been a meaningful enhancer to the pension fund. Yeah.
Can I make a kind of a forward-looking comment?
Yes.
So Ron's doing a good job characterizing the current portfolio, the performance that's been generated. On a going forward basis, what we expect is likely to happen to come out of the asset liability study is this concept of an asset class that's inflation sensitive, that has these very specific kind of goals and objectives, will not survive. That was really a function of statute back around maybe 2008, 2009.
9 and 10.
Yeah. And it started initially as essentially a commodities allocation, and then we expanded it to be much more diversified. But going forward, kind of the thinking is that we'll have a more traditional real assets kind of structure. So infrastructure, done notable allocations with good success to infra, but relative to a lot of institutional portfolios, it's actually quite small. And so in the infra space, natural resources, ag, I think that's where most of the portfolio will probably, go. Some of the inflation-linked bonds, that may actually transition over as still a staging portfolio, either to the broader credit portfolio that I referenced earlier, or some of it may stay back and be a staging portfolio for infra. That'll be a tactical decision that we'll make. But in terms of how we look at the world going forward, with the Investment Modernization Act, we're not going to be handcuffed to have this kind of idiosyncratic point in time concept of a commodities oriented portfolio.
Yeah.
Go ahead, Ron.
No, Kevin is exactly right. The real assets and diversifiers or infrastructure may be more of a meaningful dollar amount on a go-forward basis. But even in a hindsight backward-looking basis, that sub-strategy has done really well for the plan. And with Andy and Ming, I only see it getting better moving forward. This slide deck shows the different strategies of interest on a go-forward basis. Historically, we would show this slide and look at things specifically to gaps, or we want to make sure that we look at the slide deck and say we're allocating only to gaps or only to things that have valuations that are really attractive in today's moment in time for us. And at a high level, these are the moving to the right, the 4 different areas that we're really excited about at a high level. But I'm gonna turn it over to Andy to talk about.
Yeah, I mean, the way we're looking at this, when you think about strategies, it comes down to sectors. And each one of those sectors, as we'll talk about in the other slides, they have going in valuations that we can evaluate. And we're in this very unique situation where we're feeding on massive amounts of information coming from all of our managers, consultants, and others, that we can actually price these sectors out on a relative value basis. And that would be the beta component. And then we can actually look at the individual investments that are shown to us, and we view those as the alpha component. And really the left side is what I call the delta, is the fee structure and the leakages that come from the structures that we're in. And if we can get some combination of all those 3 components in a single investment, we're gonna do very well. So we're really focused on all 3, the beta, the alpha, the delta, the structure. And we've seen, I think I flagged about 15 directs in these sectors have already come through. So we're really actively looking at opportunities inside data rooms, direct deals, very idiosyncratic, each one of them. And this one, so if you think about that beta component, that's all we're talking about here. So when we look at E&P, we might see opportunities trading at 4 times. You might see data centers trading at 30 times. Doesn't mean that you always go for the lower valuation, but the going in valuation is attractive in some sectors versus others. The growth story could be very different. But when you find areas like, agriculture trading at really low cap rates, well, what if I have an agriculture and a water rights deal in combination? I can get 2 sources of return at the same time. We have one transaction we're looking at like that. Timberlands doesn't kick off that much in yield. So Timberlands as Timberlands may be a red, but Timberlands that could be converted to a solar development could be very interesting. So I wouldn't say that we're in or out of any specific sector, but this is what we observe going in based on how they're being traded.
Andy, for what it's worth, so of the 5 things you have coded as green, who are those at the top of my pipeline, active pipeline? So just 100% agree with what you think.
What's the 5th?
The transport and logistics aren't on my pipeline. I just haven't spent time on it. That's the only.
We have a transaction coming this afternoon that I couldn't be more excited about in the transport sector. That's a very unique asset. So we're really excited about some of the things that we see. You want to talk a little bit of tactics?
Yeah, thank you for that. So again, this is very similar to how we add value across all the asset classes. We try to use scale to our advantage. We try to use sector expertise. As Andy mentioned, we try to be tactical where it makes sense. We want to provide diversification so that this asset class can stand alone. Again, day one, this asset class was all commodities, all long only commodities. And I don't think people could actually understand or accept the volatility, what a long only commodity portfolio looks like. But moving forward, we wanted this portfolio to be able to stand alone on its own merits and add value to the broader plan. And then we're going to have more investment concentration moving forward on high conviction things. Not everything is a high conviction thing. And then we want to be able to take advantage of our longer term investment horizon and how we think about things.
And just to elaborate a little bit what Troy said about real estate. So diversification and investment concentration at the same time. The way we can accomplish that is we can have a range of managers. We've seen 25 infrastructure managers just in the last 2.5 months. We can have opportunities with a range of them to harvest the co-investment deal flow that's going to come from those relationships. Sure, we could go to a higher scale and reduce our fees a little bit more, but most of these managers are only doing 12 to 14 investments per portfolio. So how many directs and co's can we see from that? Maybe 3 or 4. We want more than that. So we can be more diversified at the manager level, harvest those opportunities, and be very concentrated in the directs. And we keep debating exactly how high we will go in a high conviction theme. And it's probably higher than people would expect. But I would say that we are larger than the size of this plan right now because there's more moving parts. Infrastructure is probably underallocated, as we mentioned. So people look at us a little differently and they think there could be a lot happening here. So I think that's why we're getting the attention we're getting now. This might be a little bit of a honeymoon because if we start not being able to process the opportunities or not everybody gets capital, we won't be the most attractive at the ball. But right now we have and are enjoying a lot of opportunities. So our goal is to be very selective. There's been some high profile co-investments and directs continuation vehicles that we've actually said no to. And there are others we've had to say no to because we haven't had the time. So there is a significant resource allocation to go as deep as we need to on these opportunities. As I mentioned, you can't process these in 2 weeks. It's not to the level we need to. And we do debate as we bring things to the IC, how much is too much. We had a transaction a couple of weeks ago where we triangulated that from 6 external investment managers and industry experts, which might have been a little overkill, but we want to make sure we get it just right. But every time we do that, we may lose opportunities because we're not on to the next trade. So it's a process that's evolving, but I would say, our tactics are to focus not just on these returns, but also the multiples. We're seeing transactions that we think the investment hold period would be longer. We've been doing no fee, no carry deals already, and that doesn't have the same incentivize to trigger an exit. So we think we might have reasonable returns, but exceptional multiples over time. So a lot of things to try to harvest the opportunity sets that we're seeing.
This slide just shows if we're able to do all the things that we talked about and build on the things in the past, we want to improve our long-term return and risk management. We'll probably be allocating incremental dollars to more illiquid sectors. But we still want to make sure that we maintain diversification, as Andy alluded to. But we also want to make sure that we have the right amount of staffing for the types of deals and transactions that we're going to be prosecuting on a report basis.
And I would probably just highlight the third bullet. When we're doing these COs and directs, we're deploying that capital immediately. There's very little of the subscription facility games going on. So we're getting that money to work, and we're doing it at a valuation we're comfortable with. So we have a defined portfolio we can evaluate. A discretionary manager, we can't control that valuation. And if the market moves away from us, they still really have a mandate to deploy, and they're likely to deploy at even strained valuations. Where we're taking some haircuts are the presumed exit multiples and underwriting on some greater conservative assumptions. But we're getting much more visibility in the actual assets we're buying through this program. And I think that can't be underestimated. And we didn't really talk about it or have really highlighted it much today, but leverage is a big consideration, not just this asset class, but all of them, because a lot of the leverage structures tend to be similar across asset classes. When you think of infrastructure, real estate, some of the leverage buyouts, we're sensitive to these mini perm structures where there's big debt amortization, bullet amortizations out 4 to 6 years. We can't be overlapping capital markets risk in common years, like a 2008. We saw very high quality stabilized assets result in 100% equity write-offs. So we're being very, very focused on finding real assets that have longer dated investment horizons matched with longer dated capital structures, just for an example.
And the last slide is how we access the opportunity set. And historically, we've done a lot of SMAs. Today, we have about 60% of our exposure through SMAs, about 40% through commingled fund structures. I think commingled fund structures have a place going forward, but they'll be less. Don't necessarily know if they'll be in the format of a pure SMA sitting alongside the fund, or whether or not it'll be in a commingled fund. And then we have the potential to harvest the co-investments and directs. But, you know, with Andy, Ming, and others coming, I think we can really, really take advantage of our relationships with our managers and truly prosecute a really thoughtful co-investment mandate that will drive returns in the long run. Anything else you want to add?
I would just say that the co-investments and directs, I mean, that's going to be limited by resources and capacity to process those properly. You know, we're not doing every co-investment that comes through the door. It's a small percentage that actually make it to the debate in the investment committee. So that takes a lot of time. So we could see more in those areas. But right now, that's probably a reasonable limitation.
That said, the capital intensity of these sectors is unlike anything else we do.
Yep.
With the ability to deploy at material scale in individual situations, you will see from us.
And it's hard when we have to say no, only because we did not have time to get through the data room in their time frame. We reverted back a couple of times and we said, it's us, it's not you. And we might have been able to get there, but sometimes even 2 months is not enough time.
Any questions?
Thank you. Appreciate
All
it.
right.
I won't need any more chairs. Your water or somebody else's. Just about this water. All right. Sure, everybody's getting hungry, so I'll keep this relatively brief. Those of you, I think I've met everyone, just a little bit of background. Ty Powers, I'm leading multi-strategy investments. Some of my background, I started in private wealth management after undergrad and then went to business school over at UNC. Post-business school, did equity research, both on the sell side and buy side, at an investment bank and then at a long-short equity hedge fund. And then joined a fund of hedge funds based here in Raleigh for about 7 or so years. And before I joined the state plan. So I joined initially in 2016 to help try and build the multi-strat sleeve. That never really kind of came to fruition. So I spent most of my time on the credit portfolio as well as real assets, but still kind of looking over some of the handful of investments that were in multi-strat at the time. I left the plan in early 2022 to head up asset allocation for a wealth management firm and ended up coming back a couple months ago to try it again on the multi-strat side. So this will be less about talking about what's in the portfolio right now and more about the direction that we want to go in as we build this. And again, like nothing is necessarily written in stone at this point, but it kind of gives us directionally where we'd like to move forward and putting pieces in place here.
One forward-looking comment again is in the asset liability study, we're expecting an outcome will be that this allocation goes up pretty significantly because I personally have always liked the concept of having a very flexible, go anywhere, do anything kind of portfolio and or an asset class, if you will, and really over the years, a lot of the pension funds in particular have been hidebound. There's boxes. Things have to fit in boxes, otherwise go talk to the family offices, go talk to the endowments. And I felt going all the way back, to 06, 07 at Florida, that we were missing out on all kinds of things. And so we made an evolution there, which played out quite well during the GFC. And I think that's what I'd like to be able to replicate here. A lot of ability to be flexible, move in real time, and really be able to touch all kinds of different exposures when they make sense. So as we build out the team for Ty, I think this will be a much larger allocation than we have been putting.
So I'll cover here the objectives of multi-strategy. It'll take me a minute to go through the current allocation, recent performance, and then really focus on the proposed build out and why we believe a multi-strat allocation will be beneficial for the plan over time. So kind of regretting putting this slide in here because it's got like the same investment objectives as every other asset class that's already come by. I think the kind of pivoting here, the key with this is how we achieve this and the methodology there. So just to kind of boil it down, we'll be focusing primarily on using hedge fund strategies across asset classes, tactical trading sleeves, and the like to generate those attractive returns. And I think the key, which Kevin just hit on, under that diversification piece, we're not looking to put diversification in just for diversification's sake. I think doing so will typically lead to disappointing returns, but we're looking to put as much flexibility into the multi-strategy sleeve as we can. So both from our manager's standpoint, enable them to pull the levers and move from whether it's a strategy or an asset class where they can get bigger or smaller in based on mispricings or dislocations in the market, but also for us, maintain enough liquidity within multi-strategy so that we can make those changes from managers, strategies, asset classes, and do those, efficiently and effectively. So the sub-strategies here, this is kind of a toolkit, right, that we have at our disposal. Multi-strategy funds, they're funds that execute on multiple strategies across multiple asset classes. They can be multi-manager, they can be one book. It's a pretty wide, we'll cast a pretty wide net. It's a broad field. Relative value strategies, those, really trying to exploit mispricings between asset classes or within capital structures. Think convert our statistical arb, that kind of thing. Event-driven, those are more hard catalysts, corporate change that these managers are trying to target, as well as some stressed and distressed opportunities when they come about. And then on the right side, I mentioned earlier, tactical trading. This could kind of wide also. It could be CTAs focused on long-term trend, short and intermediate term trend, be systematic macro. I think one of the keys for us will be getting a discretionary macro manager in the portfolio pretty soon. So, and again, with that flexibility to thematically allocate where they see the best opportunities. And then finally, this opportunistic sleeve, I think, is the most important within multi-strat. And that's where we can do separate accounts where, we can take an outsized position in a macro trade from one of our discretionary macro managers or from one of our multi-strategy managers that sees a fat pitch opportunity or something with a high conviction in, and we can take a position in a separate account or co-investment sleeve.
Same thing on the event-driven side. You know, they may see opportunities where they have an opportunity to be even larger in a certain investment but they don't want to get you know, too exposed within the fund. So we can partner with them and put them into an opportunistic sleeve. There it goes. All right, told you I'd be quick on this one. So this is the multi-strat right now. About 2.7 billion in assets, a little over 2% of the plan. So pretty small. The bulk of the assets are in an options-based rebalancing program. So that's really meant to keep our equity exposure within a certain range by selling calls and puts and harvesting, you know, volatility premium if it doesn't hit those targets. Primarily, it's basically, there's a lot of beta in it. It's they use, you know, futures in equities and fixed income, and then sell the options on top of that. So it's really kind of a muted beta play while harvesting some option premium. And then we have the event-driven strategy at 15%. We've had that since it's about 2016, and we just made an additional. Well, we're in the process of making an additional commitment to that fund. There has not been a new commitment to multi-strategy since 2016, aside from one small co-investment through that event-driven manager. Am I going fast enough? That's good. All right, next, performance. Look, it's okay. We've beaten our benchmark on the 1, 3, 5, 10, and even 15-year basis. Is it the type of return profile we ultimately expect on a go-forward basis? No. We think we can do better than this and, you know, be kind of in the high single digits plus once we have a whole portfolio put together. At least that's the goal. So not a ton really to expand on here. It's kind of reflects that options-based rebalancing program with a little bit of juice from the event-driven sleeve. So next, kind of took a step back just and like with a blank sheet of paper, what would we want for this portfolio over the long term? What would we want it to look like? And that bottom chart kind of gives you a picture of, basically a guideline of where we think this portfolio can be built to over time, but with a lot of flexibility across those strategies. So you can see, you know, kind of the core pieces in multi-strat and event-driven, and then significant, you know, kind of target weights to relative value and tactical trading, keeping that opportunistic sleeve kind of in the mid-size on this pro forma portfolio, but with a really wide range of 0 to 50%. And that's kind of the whole point. A lot of these strategies will be more liquid than others. So we want to have that flexibility where we can take from the liquid strategy that maybe did well in a market dislocation and put it into the dislocated asset and vice versa. We think we can target a beta of about 0.25 to 0.5. So less directionality, but with the flexibility to get a little more directionality and to generate decent returns. Vol tick up to 7 to 9%, and like I said before, hoping to generate a target return of 8 to 10% over the long term. I did like Troy's concentrated diversification. I've been saying doing more with fewer, and that's kind of how we're thinking about building this portfolio as well. Partnering with typically larger managers that can fulfill multiple areas within the broader sleeve of multi-strat, and also provide, some of those opportunistic trade, whether macro trades or co-investments that we want also. So again, like we'll be concentrating this portfolio as well, and just looking for those managers that can fulfill a couple of these buckets for us. Short term, so we also kind of wanted to set expectations that, look, it's going to take a little while to build this thing. So we want to put the core pieces in place, namely, we've got event-driven in there, great. Multi-strat will be, kind of next on the board, as well as within tactical trading at global macro. And we may do that through a dedicated kind of global macro strategy, or we may just do some co-investments alongside of a manager that does global macro on a long-term basis. So, again, that's just kind of to set the table of where we'd expect to move over the next 6 to 9 months as we get our work done. And we'll still maintain a decent chunk of that options-based rebalancing program that we've got in there. That's kind of in that opportunistic sleeve that captures that right now. All right, I'll tear through this stuff.
On the prior slide, just real quick, recognizing that you're still kind of finalizing the allocation to the strategy, will you have liquidity targets within it? Because this is, of all the strategies we talked about, the most eligible, obviously, for rebalancing in times of uncertainty. Yeah. And yet I contrast that a little bit with like the multi-strat, which again is only going to be 20% targeted, but difficult to get great liquidity in this strategy now. How are you, both of you think about kind of liquidity just really at the aggregate pool level, or do you have targeted liquidity ranges within a strategy like this that could grow to high single digits, I'm guessing, or mid-single digit?
Yeah, most of the liquidity we manage at the total plan level.
Yeah.
And that's where we're trying to be thoughtful around interim capital allocation and preserving, some dry powder when better opportunities. I think a decision that we'll have to have within Ty's book is around where we're willing to take illiquidity, for instance, in the event-driven. There's a completely separate topic, which I want to stimulate in a second, around the multi-strat managers and pod shops and things like that. But I think there can be instances where it makes a lot of sense in the event-driven space to just take the illiquidity, because we're going to get higher returns there if we execute well and the managers execute well. So I want to preserve that ability to take on some intentional illiquidity, as well as some, long bias. I think for this to work well and fit in the overall portfolio, it has to be more long biased. It's not an absolute return type mandate at all.
Mm-hmm.
Yeah, and you're right. These multi-strats, they don't have great liquidity. They're like sometimes 12.5% per quarter or 25%, whatever. It's over the long term. So again, like that options-based rebalancing program, that's chunky and it's totally liquid. Yeah. Anything we do in tactical trading will most likely be done in an SMA with FRN. We'll have pretty liquid access to those things. Same thing on the rel val side. So the really kind of on the less liquid side, which I would think would be more of your return drivers in kind of in a normalized environment, is that multi-strat event driven, and then opportunistic to really get directional if we need.
think the biggest tension we have and the biggest burden Ty faces is around what we're calling multi-strategy within multi-strat, right? Because there's a question of access and capacity with some of the managers that have performed really well over time, whether we would even get access, right? And then just kind of the talent wars between the pod shops, the level of pass-through expense, all of that is quite daunting. And so we think it makes sense to utilize managers in that kind of sleeve, but that's still an open question. And we're really interested in kind of your thoughts as to, you know, as we think about the portfolio construction over time, you know, how much should we lean into that? So you can, you know, raise your views now or as Ty kind of finishes his presentation, but I think that is a topic for probably extended discussion, not today necessarily, but as we come back and talk about how the portfolio is, you know, getting delivered.
Yeah, and that's the number one topic, right? Jobs, who's paying who, what are the contracts, guarantees, what's that like? And I've had, you know, probably over a dozen conversations with like peers at other plans and some foundations and stuff, kind of how they are viewing it also. And it's kind of becomes like, you know, not necessarily hold your nose, but like just know, you know, eyes wide open. You know what you're getting, quantify as much as you can. Like how much of that pass through is fixed versus variable? Is any of that pass through money going to these bonuses or these signing bonuses? You know, just really, you know, getting comfortable there.
Yeah. And even if we get access to high performing managers, most of them return profits.
Yeah.
So trying to maintain and grow the exposure as the overall plan will grow, which is going to happen. Again, we're battling headwinds. So some of our early thinking and discussions with the treasurer is around the ability to do co-investments frees up, you know, degrees of freedom in managing this asset class. And so Ty has put a fair bit of time into exploring and having discussions with managers who do generate co-investment flow in the global macro space and things like that. So again, the more degrees of freedom we have, the better, as long as we approach it prudently and with our eyes open, as Ty says.
And one other aspect of those types of shops, they have tons of resources, right? A lot of them have multiple economists on staff, strategists, analysts. We can leverage a lot of that for our kind of top-down views and instruct, you know, kind of how we're moving between asset classes. We can even drill down to, you know, have calls or video conferences or meetings with, you know, portfolio managers that have their finger on the pulse trading these different assets day in and day out. So that's another thing that's you know, definitely has our attention and part of the whole package, right? And then, you know, even down to using AI. A lot of these multi-strats are way ahead of the curve in implementing AI, both with the investments, but also risk and rolling it up and also managing the business. We could leverage some of that as we start to implement AI across the investment program here. So lots of intangibles there. Skip over these. So this is kind of simplistic, right? So we wanted to see, all right, what would a pro forma portfolio look like and what kind of impact would it have on the broader plan at different allocation sizes? And so we basically took return streams from a bunch of the funds that are in our pipeline that we have access to, know we can get access to, and ran some scenario analysis on, okay, well, if we got to that first step, that one with, you know, still with options rebalancing program in there as a significant portion, and we're able to, you know, kind of allocate across the other strategies, what would that do for the overall plan as we
as we ramped it up. And you can see, this just from the slide before, that right side, the pro forma multi-strat, we're targeting 8 to 10 on the return side, 8 to 10 on the vol, about a 1 Sharpe, and then just with lower correlation and muting the beta a little bit. And once we roll that into, we were calling a straw man portfolio, the impact of a 2% allocation, so the current allocation just redeployed into these types of strategies. Annual returns improve about 10 basis points to 25. It was a range. Sharpe improves a little bit. The correlation and the beta actually were pretty similar to what they were before, to equities. And then ramping it up to 10% improves your annualized returns, between 50 and 75 basis points. I think it could be more, but it's expectations. So Sharpe ratio improved from 20 to 30 basis points. And then we did see some marginal improvement to the correlation and beta metrics for the overall portfolio. So we believe doing its job. So we're adding return streams. It's less correlated, but it's not completely uncorrelated where it's just, just being added to be uncorrelated. So we want it to be added to the overall.
Sure. One comment on this for you. While this is like purely quantitative on returns, you talked earlier about leveraging relationships.
Yeah.
And it's impossible to quantify that in the model. But I think that's really important to give thought to. Where else, it's 2%, but it could create much more value than what you see on the paper that because you'll make better decisions in other parts of the portfolio, however that information helps you. I don't know that you could ever, again, quantify it, but perfectly, but you can feel it.
Yeah, and so we're want to pipe in this research from the managers, right? Again, generic research is, not worth much, but getting customized research from the managers. We have an informal kind of little team that helps support our house view. So it's Ty, Jeff, Chris, and Matt. And I think the concept is through multi-strat, we're going to see across asset class perspectives and then kind of import that. It's not to exclude views from other parts of the team and such, but we have to have ownership of that house view, and it shouldn't just be the CIO. So that's to your point, that we could get tremendous value. I've seen this already in my prior organizations where that can be leveraged realistically, also for training opportunities. So doing outplacements of team members, mid, junior, with managers for a couple of weeks, sometimes longer. And I've had really good success with that too.
All right, just kind of wrap things up here. Benefits and considerations, like it, kind of like this with any asset class, potential for attractive return profile. Love the dynamic risk allocation, the flexibility of these strategies to move in between asset classes and strategies, and provide, smart diversification. Some of the considerations, which we all know, right? They're high fees. They're hedge fund strategies. They're going to make their money. We just have to be smart about it and know what we're paying for and determine whether it's worth it. And then, a couple of the other ones here, sometimes when you go over this, the diversification thing, adding a bunch of low, negatively correlated stuff will reduce your volatility to a point where it barely has a pulse and you're not generating return. And then, finally on the transparency side, some of these multi-strategy, multi-manager firms have hundreds of PMs doing completely different things and trying to wrap your head around what is going on all over the funds, it's typically difficult. But it does help also instruct some of those kind of single strategies like in relative value or maybe the opportunistic sleeve or global macro, and really gives us a better view on most of those strategies also. So that, any questions? Happy to answer. Everybody's hungry.
Thank you. Okay, so the last formal agenda item, just give me a second to pull it up. It's the performance update. And I'm going to be very selective and just hit the high points. Not to preclude questions. We all have our limits. Okay. So assets under management, we're still sitting at about 90 billion across all of the portfolios we're overseeing. This is as of March, and since the end of March, on the retirement system, we're up another 3%. So that bounce back that we've witnessed since the initial downdraft after Liberation Day has really been quite meaningful at the total plan level. In terms of our kind of summary of our house view and the macro, it's a very challenging time at the moment, right? So we're seeing really good hard data for the U.S. economy. We're seeing a bit of a pickup outside the U.S. because there's been stimulus, both monetary and fiscal, in Europe, Japan, some of the emerging markets. But then when you look at on the margin, the soft data, Gail's dropping off your lunches. Feel free to eat. That was the intent. The soft data, with one or two exceptions recently, just looks really daunting in terms of the deterioration in sentiment, both from business leaders, purchasing managers, consumers, and so on. So these cross currents are pretty unprecedented, actually. Generally, especially since the COVID era, there's been an expectation that there's a lot of information content in the soft data and the real-time data, untraditional data, so on. But at this point, we don't really know. So we're going to have to just wait and see what the tariff impact is. And that will take a while to get into the actual hard data. Federal Reserve is on hold, even though we're getting good prints on CPI. And, on one hand, there's some jawboning of the Fed to please cut rates. It's time. On the other hand, if you look at overall financial conditions, there's lots of corporate borrowing, whether it's through bond issuance, tons of demand. I mean, we see that through Jeff's desk. And then there's plenty of private credit available at pretty decent spreads, again, really tight. So our sense is financial conditions still remain pretty easy overall for the U.S. economy. And then, of course, the Fed is going to be conservative around what's going to happen with the tax bill as it gets through the Senate and conferences and so on, and there's risks around tariffs. So our general view is, switching over to the market side, is that the support for risk assets, even though we have, as I noted, had this really strong rally in risk assets, whether it's equities or credit, we see there's still plenty of concern around valuations in the U.S. Earnings for the first quarter in the U.S. were pretty respectable, but on the margin, they're softening a bit. There's still some pressure on margins. When you look at rates and investment grade credit, again, similar to what we talked about in February, the level of rates of yields is supportive, but we're also seeing the back end of the curve continue to creep up with the term premium because of worries about the deficit and how that all will play out once the tax bill is finally passed. And right now, some of the estimates are that it's almost like a caricature of the political business cycle that we'll see increasing deficits for the next 3 years, not in 25, but in 26, 27, and 28. And then it'll start to become more compressed as the deferred spending cuts hit. But there's so much uncertainty about the offset from spending cuts and the offset from tariff collections that it's really difficult to have a high conviction view on that, at least from our perspective. Then there's the issue with the dollar weakening and foreign demand for U.S. assets. On the margin, again, that seems to be weakening. And we see, episodes of where the dollar is weakening, long-term U.S. Treasury yields are rising, and Bitcoin is rallying like crazy. Right? So that's a bit concerning that on the margin, there could be less foreign demand for some of the U.S. Treasury bonds as well as U.S. equities. We still like, as Ron noted, low duration SBAC securities, whether it's investment grade or non-investment grade. We like the lower duration. It's a good hedge against some of the allocations we've done to the debt portfolio. We do like global macro. We don't have much of an exposure there, so that's to be built out, but we do like that as a space. I'm going to skip these, and I'm going to touch on our current positioning for the retirement systems. We're still underweight on the growth side, but because of the rebalancings, as well as the market rally, on the public equity side, we're actually up to have been just above our rebalancing threshold. For the last week or so, 3 days in a row, we were above the rebalancing tolerance, and we started to prepare our recommendation memo. It's still in draft. And as of closed yesterday, we're right at 2%. So we're again in rebalance top range. So our view is we should be taking a little bit of risk off the table, and we should rebalance. I realize, as I showed you earlier, we just put money into the equity market in early April, which was timely. But our sense is there's enough risk in the markets. A lot of it's coming from geopolitical and the political side, and that we ought to just be disciplined and scrape a little bit off. And so that's kind of our intent. By the same token, we're underweight rates and liquidity, underweight investment grade fixed income, and we're okay with that. We think there's still risk with longer term rates moving up, given the uncertainty around the deficit. So our inclination would be to top up inflation sensitive. And again, those staging portfolios, like we talked about earlier, that have, these are tip substitutes, so it's shorter duration, ABS, and structured credit, those kinds of things. That's where our mind is at. That on the margin, we might move 50 to 100 basis points out of public equity and then rotate that over to the inflation sensitive side. So that's happy to take contrary views or confirmatory, but that's our current thinking.
The only other place we might want to move it, 6 of one, half dozen the other, to some degree, is optimistic fixed income.
Yeah.
But that's where we actually run into a statutory problem. Being the cap at 7.5% is something that's on our mind. Should legislation pass, that cap goes away, but we live with that cap right now. So that's the other constraining factor in the rebalance exercise.
Yes, that's right. I'll jump forward to the new and incremental commitments we made. So just to clarify one thing, it says sent February 26th. It's actually a little bit earlier than the 26th because when we go to print, we don't have everything that we've actually closed before the 26th. So you'll see a few on here from the 25th of February, 21st, and so on. You can see, based on the closing dates, some of this was due to the rebalancing, so that 4/7 and 4/11, That's where we did that tactical rebalance in early April. And as I indicated in the major initiatives, you can see where we allocated a bit to the Russell 1000 passive, but mostly it went to this US core factor. So that's a quantitative active portfolio we run internally that kind of is more skewed towards value factors and small cap, mid cap, and so on. Smaller, I should say, within the Russell 1000. We did some incremental allocations to investment grade fixed income in the private equity space. There's this long NCL2 USA, which is an Ares mandate where we do secondaries and co-investments. Is this co-investments only? Mm-hmm. Yeah, there you are. And we have several flavors of that. And then we did an allocation to HG Saturn as well, which is a relationship we've had for many years. We weren't committing for a while, but we've reinitiated that relationship. And alongside that, we'll have co-investment SMA of notable size as well. That's still in the pipeline to get closed. And then in the opportunistic fixed income, you can see we have a relationship with BC Partners, their credit sleeve, and TPG Angelo Gordon, which is a longstanding relationship that goes back quite a while. And that was an incremental allocation as part of the rebalancing that we talked about in February. And then the last two are these inflation sensitive portfolios that are the TIP substitutes. So one is with Double Line. That mandate was created as a better way to get inflation sensitive returns without investing directly in TIPS. And then the BlackRock Garnet is a similar strategy. These are the staging portfolios Ron referenced. BlackRock Garnet, the exposures there are intended to mimic the composition of the CPI. So if you think about housing, healthcare, that drives CPI to a large degree. So Garnet tries to replicate that and get similar exposures just in fixed income and a little bit of privates. Where's Ron? Oh, there you are. A little bit of privates as well. 5%. Yeah. So.
And that line item is so significantly outperformed TIPS.
Yes.
So, all right. Like, is there any thought to rebalancing actually into just vanilla TIPS?
Well, funny you should ask. We have an open question actually for this rebalancing I referenced that we're contemplating as to whether we do vanilla TIPS. So our TIPS is 1 to 3 year index exposure. And so we're doing some total return analysis over a 1 year horizon of BlackRock Garnet versus the TIPS index. And so low cost, obviously, but it all has to do with what the expectations are around future rate of inflation, right? Yeah, but that's what we're looking at right now. We exited one manager. Performance had been mixed over time, so this was an early move as part of our rebalancing with the ability to exit managers. So we exited Tobam, two portfolios. That Tobam was so one they were running directly, the other they were working with us to implement. And then in terms of our new fund pipeline, I won't go through these in great detail. We have, 5 at the top of the table across multiple asset classes that have already been approved. It's a matter of closing. We expect to close those this month. And then the rest are in the diligence stage. In our internal lingo, these would be an intensive diligence. So a number of these have already come to the investment committee as a teaser. Some are close to the recommendation stage, but we would still call that diligence. They haven't formally cleared the committee and gone to the treasurer for a final nod. And fair number of co-investments, I think about eight new relationships. So again, the market understands that we're open for business and we're getting good response, good deal flow. A few of these are a little bit further out, but yeah. And on the resource side, with Ben and Jason's leadership, we have 3 external legal counsel now, transactions counsel, that are working on a number of these deals. A couple are still run in-house, which is a good thing to stay active in the market. But that also gives us more bandwidth in terms of negotiations, final legal diligence, and closing. So that's a good development for us all.
One more question. You mentioned possibly a partial rebalance to what you even did just 6 weeks ago.
Yeah.
Which I think makes sense, but you are still underweight equity risk. Now, is some of that, look, I mean, take profits, great. But is some of that also in anticipation of kind of writing some upfront co-invest checks this summer at a speed that, so much faster than you might have done a year ago?
Yeah, and this is part of the tension, I guess, around, as you noted, and this is, talking about this in our investment committee as well, is we're 150 basis points light on growth, right? We're overweight public equities. It takes a while to get the monies deployed and called.
Yeah.
Right. So our concern at the moment is on the public equity side, there seems so many ways that, especially in the US, this rally will just lose its legs. And again, kind of the over under, there's so much more downside. And a lot of this could be bond driven for sure, but it could also be driven by events overseas, notably with foreign investors trying to move away from the dollar exposed assets they have in the equity market, not just fixed income. So that's our tension is, but at the same time, if we do that rebalancing, we're going to go further underweight growth. And so we'll have to backfill, but it doesn't happen overnight on the private side. So again, we haven't made a final determination on that, but that's what you're
talking about. Okay.
Yeah. Okay. In terms of performance, I'll be even more brief. Over the past year, we're up about 5.2% for the combined portfolio for the retirement systems. We're a bit ahead of the benchmark and still below our long-term policy benchmark, which is essentially a reference portfolio of all liquid asset classes. And this is, oftentimes the case when some of the public markets are doing particularly well, notably equities. Still below the actuarial assumed return. Although when we do the roll forward, I think for the fiscal year to date, so that would be June to now, we're pretty close to the actual return. So it's turning out to be a pretty good year, but obviously a lot could happen between now and end of June. The attribution for the 1 year, so again, we're ahead of the benchmark by 29 basis points. The allocation effects or the attribution is broken out into the selection as well as the allocation effect. So we're modestly ahead 9 basis points on a 1 year basis. Through allocation, you can see down below in the middle panel that a lot of that is coming from our underweight to non-core real estate. So again, that asset class, the market overall has been quite weak. So the fact we're underweight helps. We have a modest benefit from cash, from being overweight as we've gone through some volatile time periods. On the selection effect, it's opportunistic fixed income that kind of stands out. And private equity, non-core real estate, you saw some of the shorter term numbers. We've been lagging our benchmarks, but I wouldn't say that's terribly meaningful, particularly when you think about the program going forward. We have a lot to do there as we restart. The 3 years here, the value add is a lot larger, and it's because of the allocation effect. Again, the returns over the past 3 years have been pretty muted at 3% for the plan, and that high cash allocation, the excess cash, benefited the plan in that environment. So that stands out as an allocation effect of 32 basis points. The only other thing I'm going to touch on is just for the record, to kind of put up the performance versus the peer group. So we're using the Bonnie Mellon custodian, U.S. public plans greater than 20 billion. And over the shorter time periods, as we've noted, significant underperformance versus the average or the median plan. In returns, our risk has been actually a bit closer to median. And our Sharpe ratio has not really held up at all. So again, this is our focus around first governance, redeployment, rebalancing. This is what's driving a lot of what we're trying to accomplish. Progress will happen over time. So that's our commitment. I'll stop there. Happy to answer any questions and
Right. All right. Thank you very much. Appreciate everyone's efforts and all the work. I know it's a tremendous amount of work. Love to get everybody in ties, so we're going to do it again. Let's move over to the public comments section. Do we have any public comments?
None listed, but if there's anyone in the audience who would like to.
It's like,
right. So,
all right. Okay. We'll consider the public comments section closed. And I think that's it then. Sorry. That's it. Okay. So we'll call for a motion to adjourn. I don't know who made that motion.
Jamie.
And then a second. Second.
all right. All right. Well then, for the roll call, we'll just go down the line. Mr. Brewer.
Aye.
Mr. Durden.
Aye.
Mr. Kennedy.
Aye.
Mr. Spencer.
Aye.
Mr. Ward. Treasurer Brennan.
Aye.
We have approval to adjourn.
All right. Thank you, everybody. Appreciate it.